the market is willing to pay a premium for that scarcity of growth.
Barring some sort of crazy financial market event, I think that we should have a fairly stable move here.
Core is remaining really sticky, and it's really unclear that the trend lower extends.
The overall state of the economy is better. It's certainly much, much better than people expected it to be.
It's very possible that the recession slowdown, part of that has already, been brought forward if you want.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Price always leads sentiment. Live from New York City this morning.
The words of the wise.
Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Getting your week started with equity futures on the S&P, just about positive. Here come the upgrades. Goldman Sachs, David Kostin, raising their year-end S&P 500 price target to 4,500. Looking for something close to 5% upside, TK, from Friday's close.
We're going to see a lot more of this, and it's coming up into where we are. Every note this weekend says, look, here we are up 20% off the October low. Ben Laidler out front of David Kostin on enthusiasm for this market. But critically, as you say, John, they've got the same vision now to where we're going, which is sort of kind of like up, but we really don't want to reach out there.
The characteristics of this call as well, really important. The potential, Lisa, for this rally to broaden out, something I know that you were looking at through last week. Month to date, it's pretty clear. Outperformance on a Russell, outperformance on the regionals. TK, last week you asked, how are the regionals doing? Still on the mat, but trying to get up. And we've had how many weeks of gains now? Quite a few.
It's been 3 or 4 weeks straight of gains on smaller bank stocks. How long this can continue, it's anyone's guess. It's part of the parlor game. Right now, a lot of it seems to be predicated on the idea that the Fed is going to pause, whether it's hawkish or not, that they're not going to raise rates this week, and that also you aren't going to necessarily get any more banking collapses.
This month, the Nasdaq up almost 2%, the Russell up by more than 6%. Just to build on what Lisa said about the hope that we don't get more banking collapses, the regional banking index up 12%. So are we seeing a genuine rotation or just repositioning? Stuart Kaiser of Citi, Tom. Our sense is the move is more driven by short covering than adding longs. That's his take right now.
This is really important. We covered this last week, and Mr. Kaiser, I thought, was just a really huge value add from Citigroup. You're on the mat. You're down. The first bounce up is that. It's the gloom crew getting wiped out, and up you go one leg. And we've done that in the broader market. Certainly we've done it in the techs, and now we do it in the regional banks. It's the then what after that, which, to Mike Wilson's point at Morgan Stanley, you got to earn the then what with some earnings stability. He questions that.
Morgan Stanley pushing back. Mike Wilson has not changed his tune for anyone who's tuning in and wondering if that's happened just yet. As far as I understand, Mike Wilson has not changed his view based on his most recent research. Marko Kolanovic of JP Morgan, he will no doubt publish a little bit later this week, and we'll see if he changes his tune a little bit later this week as well. If you are just tuning in, welcome to the programme. Fantastic weekend of sport. Fantastic week ahead in the markets too. CPI tomorrow, then on to the Federal Reserve. Going into all of that, your equity market slightly positive on the S&P 500. Futures up by 0.2%. In the bond market, yields just about unchanged, up by almost a basis point. Lisa, here the 10-year, 374.91.
You're talking about the week ahead. Today, a bit slower into one of the bigger weeks of this year, particularly because it comes as the pivot point of all of the mid-year reviews come out. The rate decisions include Wednesday, the Federal Reserve coming out, Thursday, the ECB, Friday, the Bank of Japan. How much have we basically priced out additional Fed hikes, and what does it mean if they don't deliver? If, let's say, they do hike rates, or if, let's say, they don't hike rates and they say that they're not going to necessarily hike rates further, how much do they become sort of the bull market fosterer versus the bull market killer? Economic data, Tuesday U.S. CPI, Wednesday PPI, Friday Eurozone CPI. Very curious to see whether we see ongoing deceleration there. It might be more important, as Kit Duke said, than the Fed or any of the central banks. And in the politics sphere, we have to say this, that former President Donald Trump is expected to appear in federal court in Miami on Tuesday. He is expected to appear before a judge at 3 p.m. How much oxygen is this going to suck out of the room, John, as we all wait for a Fed decision?
It's in the recent polls.
Yes.
CBS, YouGov, that's the elephant in the room going into the campaigning for the election. 61% Trump, DeSantis 23%, Scott 4%, Pence 4%, Haley 3%. That's the latest poll, TK.
We'll talk about it. It's fluid, to say the least. I would just like to say that the elephant in the room is tomorrow's inflation report. All of this discussion waits on a single statistic. Course, I never have said this. Core CPI, month over month, no other number matters. If it's up a tick, all hell breaks loose. If it's down a tick from 0.4%, all hell breaks loose.
Are you ready to pay Skip pause, hike roulette?
Not yet. I got to wait and see the data, and I
Okay.
think you're going to hear from governors and presidents. They feel the same way.
John Stelfus, Chief Investment Strategist at Oppenheimer Asset Management, having a better year this year, John. It's good to see you. Let's talk about it. We were discussing not just the headline movement, but whether this is a genuine rotation away from the outperformance of mega cap tech or just a subtle repositioning in the last couple of weeks. John, how would you characterize it?
Well, thanks for having me on, guys. It's great to be on surveillance this morning. I have got to say that where we are right now is beginning to see a rotation that carries on from the rally that began on October 12th of last year. We've seen information technology, communication services, and really take off in that period. But now you're seeing gains in industrials, materials, consumer discretionary as well in that space of time. And from there, we've seen the broadening into small caps and mid caps, which don't get much of a mention by most people these days.
John, I want to know, and congratulations on being in the market and participating. You absolutely nailed this. Somebody walks into OpCo today, an institutional investor. They've missed this market. What's the first thing they should do? What is the Stolfus action plan to catch up?
Well, of course, it depends upon all the intricacies.
For instance, their to risk and mandate that they have. But what we would say from the first level, the point of view would be in a broadening rally, you might want to consider some of the cyclicals that have yet participated or that have just begun to participate, and consider opportunities amongst growthier value as well as garpier growth, and we would suggest market capitalizations across both small and mid caps offer opportunities as well. And so we think that you may have missed some of the major move that occurred within technology, but technology was brutally abused last year, oversold on many levels. And we think that's why it led out of here, as well as the AI interest that came in March of this year.
John, you like financials, according to your note, and this comes at a time when a lot of people are sort of shrugging off the fears of March. What gives you confidence that we're past the worst, especially because borrowing from the emergency lending facility from the Fed last week rose to $100 billion for the first time going back to April?
Well, we think what part of it is, Lisa, that you saw a really fast response on the first tranche of the problems that emerged by the Fed, by the Treasury, and by the FDIC, increased oversight now by regulators, and the fact that we just haven't had really much news to the downside on this in the financials since March and early April, as I recall off the top of my head, which would tell me that they're likely, if anything else surfaces, it'll remain most likely idiosyncratic and the result of a tendency for either hubris or just disregard for basic principles of investing at any individual bank that shows up with a problem.
A lot of people speculate that bond markets are basically saying that stocks are wrong. There is one study by JP Morgan that says that stocks should fall by about 20% if you believe what the bond market is saying. There seems to be a dissonance. If bond yields rise materially and agree with the view that stocks are putting out there, is that going to kill the bull market?
We wouldn't think so based on historical experience and our personal experience, over the last 40 years in these markets. Usually when you got a Fed funds hike cycle, of course, equities sell off in anticipation of draconian measures to occur within a Fed funds hike cycle. But once equities get an idea that this is not going to kill business, you begin to see the ability of equity prices to actually rise in periods where interest rates are high. We saw that in the early 80s, coming out of the bear market from the late 70s into 82, and going forward to 87, there were many times when interest rates were considerably competitive against equities, and yet equities were riding because of innovation, improvement in business, and just general economic improvement.
John, I hear you going over history there, and I wonder if history is helpful or confusing. I was looking at two quotes last week. and they came within almost 24 hours of each other. Savita Subramanian of Bank of America said, bye-bye bear. She said the bear market is over. 90% plus at a time. The S&P 500 rises over the next 12 months after recovering from a bear. Daryl Cronk of Wells Fargo Wealth said history shows SPX doesn't bottom until on average 6 months after the first Fed rate cut. John, which one is it, and how helpful is history?
Well, I think it would be the former rather than the latter. As Mark Twain used to say, history may not repeat itself, but it often rhymes. And it seems to be that both the resilience that we've seen related into job creation, as well as the ability for many companies to navigate this current environment and investor need for better returns if they're intermediate to longer term investors. What you're looking at, we think, are higher prices in stocks. Not necessarily up in a straight line in all sectors. You're going to see periods of profit taking. You get any kind of a catalyst for some selling without FOMO. That would create some excitement to the downside. But we think the overall movement is still headed out of the woods and with fundamentals improving, likely to continue.
Hey, John, wonderful to get your perspective to kick off a Monday morning with you and the trading week ahead. John Stolfus there of Oppenheimer. Constructive on this equity market, and right to be so. He's been right all year. After having a tough year in 2022, TK, that market is going his way.
The tough year in 22 is the optimists like Pinky Chada we heard from, I believe it was Friday, with Deutsche Bank, or Mr. Stolfus with APCO. Or I'm also going to add to this Gina Martin Adams of Bloomberg Intelligence. Yeah, you can be wrong in 22, but you're wrong simply because you have to be in the game to start the move. If you wait to go into the market, waiting for the move.
Are you speaking from experience?
You miss it.
Trapped in cash.
A little bit of experience here, folks, that when Mr. Stolfus speaks, I take notes. And the answer is, this is a huge difference with financial media and timing. These people are not timing. They don't have a crystal ball. They're like, you got to be in the game to play. And we're going to talk to a lot of those people through June and July.
We'll discuss the politics in just a moment as well. John Lieber of Eurasia Group on the former president's indictment. This from William Barr, who served as President Trump's U.S. Attorney General over the weekend to Fox News. If even half of it is true, then he's toast. Pretty scathing words over the weekend, TK. From New York City this morning, good morning. Kicking off your trading week with CPI just around the corner tomorrow, and then on to the Federal Reserve on Wednesday.
Keeping you up to date with news from around the world with the first word, I'm Lisa Matteo. Former Italian Prime Minister Silvio Berlusconi has died. Berlusconi was a billionaire media mogul before becoming Italy's longest-serving post-war prime minister. His more than 9 years in office were marked by sex scandals and allegations of corruption. Still, he was one of the most influential figures in Italian politics of the last 3 decades. Silvio Berlusconi was 86. And part of a counteroffensive to take back Russian-occupied areas is underway. The Ukrainian military says its troops have freed another 2 villages in the eastern Donetsk region. Now, the claims haven't been verified, and the defense ministry in Moscow hasn't commented. China is denying U.S. claims that it has spy operations in Cuba. In Beijing today, the foreign ministry referred to the allegations by the Biden administration as false information. Over the weekend, the administration said the Chinese spy facilities in Cuba date back to when Donald Trump was in office. NASDAQ reportedly has agreed to buy software maker Adenza for $10.5 billion. That's according to the Wall Street Journal. The Journal says that Adenza's owner, private equity firm Thoma Bravo, will get a large stake in NASDAQ as part of the deal. Adenza makes software that's used by banks and brokerages. And UBS has completed the acquisition of Credit Suisse. It's the biggest merger in banking since the 2008 financial crisis, and it creates a global wealth management titan. UBS agreed to take over Credit Suisse in March in an emergency sale brokered by the government. Now, a confidence crisis and a flood of client outflows put Credit Suisse on the verge of bankruptcy. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Matteo, and this is Bloomberg.
This vicious persecution is a travesty of justice. You're watching Joe Biden. Joe, I think of it. Biden is trying to jail his leading political opponent, an opponent that's beating him by a lot in the polls.
Former President Donald Trump speaking at a rally this Saturday in Georgia, defending himself against the historic federal indictment filed against him regarding his handling of sensitive government records. His U.S. Attorney General William Barr, under his administration on Fox News Sunday, said this: "I was shocked by the degree of sensitivity of these documents and how many there were. And I think the counts under the Espionage Act, that he willfully retained those documents, are solid counts." TK, he finished with this line: "If even half of it is true, then he's toast."
Huge deal, and really leading into headlines, and it's obviously who this comes from, and the former president will be very defensive about it. And I really think it goes to the nuance of the weekend, is this primal scream that this is so different than the other process we've seen leading up to Tuesday. And to me, Tuesday, the huge thing is, what will this judge do appointed by President Trump? To me, that's my focus on Tuesday right now.
Lisa, what's your focus going into tomorrow?
My focus is on potential unrest. My focus is on the police presence. My focus is on rhetoric like Kari Lake, speaking at a Georgia State GOP convention on Saturday. Basically, she was the one who lost a bid to be governor of Arizona. She said, if you want to get to President Trump, you're going to have to go through me, and you're going to have to go through 75 million Americans just like me. And I'm going to tell you, most of us are card-carrying members of the NRA. So this is the kind of tenor that we have in the rhetoric coming into tomorrow.
We did have a poll over the weekend from YouGov and CBS News, a poll that we'll reflect on repeatedly through this morning. One of the questions that people were asked: how might they change their view of the former president? This is likely GOP primary voters. These were the results: 14% for the better, 7% for the worst, 18% depends, whatever that means. And this one here, Tom, 61% won't change.
Yeah, well, this is the politics of the moment, and he's got his crew. I don't know if it's 74 million people in support of him, but it's an awful lot of people in those polls. And to me, who's number two? DeSantis?
Right now, yeah.
And it's like 20, right? It's like sort of kind of
You've got the former president in the 60s. You've got the governor of Florida in the 20s. And then it's like low single digits. 4 Scott, 4 Pence. Haley's in there as well.
It's going to get a lot more complex, and I think we'll learn day by day here on far more serious charges, perhaps, than what we see in New York. John Lieber is expert on this. He's United States Managing Director at Eurasia Group and joins us for a Monday brief on an historic Tuesday that we will see tomorrow. Bloomberg, and particularly Balance of Power, will have full coverage of this. John, thank you so much for joining. What's this judge going to do tomorrow? She's a Trump appointee. You know her. You can brief us on who she is. What will she do?
You know, this indictment is historic, as you mentioned, and we've never seen anything like this. And there's a whole host of considerations when you're looking at a high-ranking political official like President Trump that just aren't going to be in play with other people. The publicity, there's a major security concern. But, you know, I think we saw his indictment in New York. It in many ways, it was pretty normal. You know, the Secret Service walked him in. They had an arrangement. So Tuesday to me isn't the really important date. It's what happens over the coming months and the kinds of decisions that she'll be making to either admit evidence or exclude evidence, and how she instructs a jury if one ever comes together. There's a lot of really complicated legal questions here. And the key question to me going forward is, how do you find an unbiased jury for the most famous man probably in the world? Everybody in America has thoughts on this guy, and probably most people have exposure to this case. There's going to be a lot of tough questions for this judge going forward.
Well, this is Eileen Cannon of Miami in the federal court. Are those decisions going to begin to be made tomorrow?
They'll be made. I mean, this trial is going to take probably months to unfold. The government said they want a speedy trial, and Trump's MO in the past has been to drag out these legal proceedings as long as he possibly can with procedural motions. I can't say if we think that she has a more favorable view of Trump's procedural motions or not. There's just a lot we don't know. In the past, she has made some rulings that are favorable to the former president. But, you know, at this point, I would give her the benefit of the doubt. But her ability to fairly conduct a trial and fairly indict the president is going to be a key thing to watch going forward.
John just read the poll numbers in terms of Republican candidates, Republican voters who are likely to continue to keep their support with the former president. Are you surprised by that? Are you surprised by either how much of the proportion of people are not going to change their opinion versus those that are actually considering one way or another what this does?
Sadly, no. I mean, Donald Trump's been survived just, being political flamethrowers that would have just absolutely scorched any other politician over the last 8 years. And, you look at this relative to the Access Hollywood tape or the fact that he just lost a civil suit for sexual assault. I mean, there are some really serious things this guy has done that have not touched his approval ratings at all among a really hardcore base of the Republican Party. And now he has the opportunity to say that the president of the United States is bringing a political prosecution against him. And there's people like his rival Vivek Ramaswamy and other Republicans who are out defending him. So I'm not remotely surprised that he's able to spin this to his benefit. If I'm one of the Republican challengers that's hoping to get into the news cycle here, I'm hating this because this just gives Trump the opportunity to be the #1 storyline. All the questions you're going to be asked are about President Trump. And this election is fundamentally going to be about his role in the party and his role in the country, because he's going to be so dominant going forward.
From an international perspective, I think about some of the allies looking at the U.S. right now, and the fact that this is going on, which is unprecedented, and the fact that there is such fiery rhetoric and potential threat surrounding tomorrow's court hearing. What does that do to the U.S. relationship with its international friends?
Yeah, I think the big challenge to the U.S. right now is that it looks a lot like some other countries that we've criticized quite a bit in the past. And I think that the great things the U.S. has going for it are the strength of its institutions, and that includes both the courts and law enforcement. So the fact that you have half the country believing that law enforcement has been fundamentally corrupted and delegitimized, and that message is going to get out and resonate around the world, it really undermines faith and belief in U.S. institutions, not just domestically, but globally. And that's a bit of a problem when you look around the globe at countries like El Salvador or other places where you might start to see democratic backsliding, and the U.S. doesn't really have the ability to step in and criticize anymore. And in some cases, it's not even trying.
John, I wonder if it's something more specific as well. If you're a U.S. partner right now in the West, a European country, the UK, for instance, are you questioning how you share intelligence with the US if this is what happens?
I don't think there's a belief. I mean, Joe Biden, yes, he had some boxes in his garage. The National Archives found out about it. They came to take him back. I think that Trump is a bit of a unique figure here. However, the U.S. does have a broader problem with intelligence leaks. I mean, you've got this National Guard, very young guy, who was leaking these documents that is now doing quite a bit of damage. So when it comes to the national security, the actual documented damage to national security that we know about, so far, the Trump documents, while his actions were quite bad, don't come close to some of these other cases. And I don't know if this case in particular pushes the allies away from the U.S. over that issue.
Interesting. John, thanks for your perspective. Appreciate it. John Lieber there of Eurasia Group, going into truly a historic week. Tomorrow, Tom, it really starts in many ways on both the political side and the market side. This country, though, TK, my experience of it over the last 8 years or so, just totally desensitized to some of this because it has been a constant crisis. Year after year, there has always been something which has led some people to believe that maybe this isn't one either.
I was reading about Prime Minister Johnson this weekend and his exit from the Conservative Party.
Sure.
And it seemed tame compared to, as you say, the way we bounce around here. I mean, and there's a real exhaustion about it by liberals and conservatives and a huge body of the public in the middle. I think we're just all exhausted out by the debate.
And some people, Lisa, for that reason, overlooking the potential seriousness of an indictment like the one that was unsealed going into the weekend.
And the other potential opponents in the Republican race coming out to back Trump.
Oh, they don't know what to do.
Yeah.
They don't know what to do.
Correct.
I imagine if you Governor DeSantis, maybe with the benefit of hindsight, you would have waited a couple more months before throwing your hat into the ring. From New York this morning, good morning. Future's positive. Live from New York City this morning. Good morning to you all as we start a really interesting trading week. Looking ahead to CPI inflation data coming up tomorrow morning, then on to the Federal Reserve on Wednesday. Going into all of that, your equity market just about positive, up by 0.1%. The longest weekly winning streak of the year so far. In fact, the longest weekly winning streak going back to August of last year. The S&P 500 closing out last week for a fourth week of gains and adding the tiniest bit of weight to the rally this morning. Some people think it's going to go much further. Goldman Sachs with an upgrade over the weekend.
Big one.
They're looking for something like 4,500, an upgrade from 4K. That was their previous view into year end. And I think beyond sort of the headline number, they're looking for this rally to broaden out beyond the Nasdaq. And over the last month to date, for the month of June, the Nasdaq underperforming the Russell. This morning, the Nasdaq outperforms on the session. We're up by 1/3 on the Russell, up by 0.1 Tom.
Very quickly, oil. I will look down at the screen. First look today, $67 a barrel. West Texas Intermediate was like, oh.
Jeff Curry downgrade. You see that?
Yeah.
Yeah.
And it's a little bit, it's off the topic right now, but nevertheless, oil 68.46, Brent crude 73. Can you imagine a $69 Brent crude? How does that play in Riyadh?
They're not far off, are we?
Yeah.
I don't think Riyadh is too happy right now based on some of their recent communication. Check out the bond market, 2-year, 10-year, 30-year. Over the last week or so, yields drifting higher, the 2-year higher by about 10 basis points or so. The 10-year up by 5. All of this going into the Fed. 459.81. Yeah. Tom, I think we can call that 460 at the front end.
And critically, the 2-10 spread at 86 basis points of inversion. Folks, for those not keeping score at home, that's a big deal. We are buttressed right up against max inversion on a moving average basis. If you get a week or 2, 3 weeks more at this level, that's really germane.
Interesting to see how the equity market might connect with what's developing in the FX market. Just to finish on the euro, as you start to get some cyclical outperformance domestically in the United States of America, you start to see the Russell outperform the small caps, the regional banks again. The euro just showing a little bit of strength. Squeezed out a weaker gains on that currency pair against the US dollar. And right now, 107.80 is where we stand on that currency pair into the Fed on Wednesday, into the ECB on Thursday. A little bit of a stronger euro here, a softer dollar. US May CPI is due out tomorrow, followed by a Fed decision on Wednesday. Jennifer McKeown of Capital Economics weighing in on this and saying the following: there appears to be enough support on the FOMC for a pause, but the statement and new projections will make clear that this is not the end of the hiking cycle. We now expect rates to be raised again at the July meeting. So, Tom, that sounds like a skip. June into July.
Yeah, every shop is different, and I really want to make clear, Capital Economics from its formation, the first essay written has been really different. Very thoughtful essays that globally tie in regional economics. Jennifer joins us now, the Chief Global Economist at Capital Economics. Jennifer, just a superb note here on, forgetting about Japan as its own oddities, but on 3 central banks, and I want to take a broader view right now, not the skip, pause, parlor game, but I want to talk about how 3 central banks are doing in a post-pandemic world. Are the banks, the Fed, the ECB, the Bank of England, are they beyond the pandemic?
No, I don't think we are really in several senses. I mean, the key one is inflation, isn't it? And the inflation shock. During the pandemic, it looked like a lot of this inflation pressure was transitory, and everybody talked about how it was likely to fade quickly. But there's clearly been a huge reappraisal. There's had to be, as core inflation pressures in particular have remained so persistent. Even now that in the developed markets, on average now, energy inflation is close to zero, and yet we've got core inflation still very, very high. So central banks are taking a really long, hard look at just why that is and how likely it is to be persistent, and being very cautious in their appraisal, given that they've made mistakes in the past.
What is the McCowan certitude measure right now of these banks? Do they feel like they're flying blind and they need more data, or do they have a grasp, a handle on where they're heading?
I mean, I think they have as good a handle as they could have at this stage. The problem is that the things have changed so much that there's clearly been this shift in the inflation psyche, that core inflation pressures and wage pressures are an issue in a way that they haven't been really for decades. So it's extremely difficult for the central banks to get a handle on just where it goes from here. And I think that's why they're waiting for evidence in the data, not relying so much on their forecasts as they may previously have done, but thinking much more about just what is happening in the data, whether we're seeing clear evidence of core inflation come down, and crucially, whether labour markets are easing up and whether we're seeing reduced pressure on wages.
We're not getting any clear messages at all from the data. You can pick your message and you can get it correct based on the data that you select. I'm just wondering which data this is going to really make a difference. I mean, in the CPI reports that come out on Tuesday and then on Friday in the Euro region, is that going to make more of a difference and frankly be more important to markets than anything that central bankers have to say?
Oh, maybe, but perhaps particularly the core inflation figures and what's happening to underlying inflation, services ex housing in the US case. And I think really, as I've said, I think wages as well are going to be really important. We're getting some data out of the UK this week that are likely to show wage growth still extremely high there at around 6%. And I think markets are going to be listening to that or looking at that and listening to what central banks say about those data releases, obviously, whether they're still really seeing reasons for concern in the labour market indicators and in the indicators of underlying inflation. And I think really that's what you're going to see across the board this week and next, that the central banks still really aren't comfortable with where these indicators of underlying inflation sit and with the tightness that we're still seeing in labour markets.
What would we have to see on tomorrow's CPI print in the U.S. for the Fed to lock in a rate hike Wednesday?
To lock in a rate hike on Wednesday, I think it would probably take quite a lot, but a significant increase in core inflation in particular would be clearly a major shock. We're expecting a fall from 5.5% in core inflation to 5.2%. So were it to stay around 5.5% or even rise further, then I think that would be a real cause for concern.
Jennifer, the Bank of England seems to be in a different place. Ambrose Evans Pritchard wrote a great essay on global disinflation, whether you agree or disagree, and he ended with the United Kingdom as its own outlier. How much of an outlier is the Bank of England compared to the other two banks?
It's something of an outlier. So as I said, wage growth is 6% in the UK, which is really, really high, higher than elsewhere, and a major cause for concern. The bank probably has a few more rate hikes to go. We're expecting another one next week, and we think the peak will probably be around 5.25%. So it might continue hiking for that little bit longer than the Fed and the ECB because of that stickiness that we're seeing in wage growth and the tightness in the labour market. But there are signs around the labour market that things are starting to ease, including in the UK, vacancy rates coming off, for example, which does point to perhaps some easing on the horizon.
Let's drill down to the United States then. Are you suggesting the inflation data tomorrow is of less importance because the heart of the matter is to see employment break?
Yes, I do think that's probably the case, actually, that really what we need to see is, what wage growth coming down, the labour market showing clearer signs of easing. Job quits are already down. There's some evidence that things will improve in future, but really you'd want to see a more dramatic easing in the non-farm payrolls measures, so that we know that the labour market really is beginning to soften, and that will feed through to wage growth. And then that's when you'd feel much more confident that core services ex-housing would start to come down.
Hey, Jennifer, thank you. Always enjoy your input, particularly on a Fed decision week. Jennifer Mickione there of Capital Economics. Remember, on Wednesday, it's not just about the decision and the statement. It's not just about the news conference with Chairman Powell. It's about the projections as well on growth, inflation, unemployment, and the median dot. Basically, the median projection of Federal Reserve officials on where they think rates will end the year. It's TK, there is a belief that perhaps because of where unemployment is right now versus where they thought it would be by year end, there's a big gap. The Federal Reserve's at 4.5%. The data right now is at about 3.5%. Most people believe we're not going to get there, so they're going to have to do something about that forecast. Growth has been better. Inflation's been stickier. All of those things will have to change, and if you want some credibility, you should probably knock up the median dot as well, which is basically the projection coming from Mike Gapin and Bank of America.
Do the dots show the labor dynamic? I don't think so. They're an inflation study. They're what's called a Fisherian study, the linkage of interest rates to inflation and back and forth. Do they show 3.x% unemployment? How do we get to 4%? Is 3.9% unemployment different than 4.1%?
Sure.
If you're unemployed, there's no difference. If you got a job, you're ignoring it. And it's always been that way.
There's some clear splintering on the committee. I think we've all seen evidence of that based on the speeches from Fed officials over the last couple of weeks. We understand where there might be some consensus. This isn't the end of the hiking cycle. We don't want to declare it so. We also don't want any rate cuts priced in this year. So, Lisa, if you wanted to find consensus on the committee, I think you can find it by essentially sitting there and saying, OK, let's take a skip, but let's imply we're prepared to do more. And perhaps one way of satisfying the hawks is to just shift things up a little bit more, perhaps bake one more in the median dot. Now, Andrew Honenhorst, the city, is already pushing back against this. if you're going to project one extra, just deliver it now and get it done with, which is always the thing for me, and I think a lot of other people at home as well. The projections sometimes are more about what they want to signal and less about what they may actually do.
I actually very much took sympathy with what Andrew Hollenhorst was saying, which is basically, it's kind of hogwash, right? I mean, essentially, where's your credibility if you say we're going to do it and we're not going to do it right now? We're going to sort of signal with all of these words that supposedly have meanings that can be upended next month. There is this question, though, about what the advantage is to pushing up the rate higher versus holding for longer. And that, I think, may be the core of one of the debates on the FOMC this week. Because if they signal, we're not going to raise rates, we don't want to break anything, but we're going to keep them here for possibly 1 year, 2 years, 3 years, all of a sudden, all those companies that need to refinance, it really changes.
I agree with the refinance thing. I think we're going to see a wave of refinancing. But yeah, I have immense difficulty with the ex-ante analysis of the financial media. They're going to wait on the data. And with Jennifer, I thought she was brilliant. The question is it inflation data or labor data that has more importance or more weighting in a dual mandate central bank? The ECB is not a dual mandate central bank. And I don't, what I love about the hawkish talk is we're basically using James Bullard as a Bundesbank equivalent. I mean, that's what we've come down to. I'm not going to put that banner up of the St. Louis, and I won't be able to get tickets to the last place.
There's some others in the mix as well.
Cardinals.
But yeah, I hear you.
They're
going to be data dependent, Tom.
They're completely ex-post data dependent. They're
the
working
Cardinals
off.
will be data dependent.
The Cardinals are data. Did you see the Red Sox took two?
I didn't watch that, but congratulations, Nick Taylor of Canada. Fantastic win over the weekend in the Canadian Open. The first Canadian to win that golf tournament in 69 years. RBC back in that. Good to see Dave Mackay, CEO of RBC, with Jim Nance on CBS over the weekend.
Did you watch Manchester City?
I did. I did. Credit to Inter Milan for putting up a real fight.
They did. It was
made that game very tight.
Really,
there was some real arrogance coming into the
game
game about how lopsided this matchup was, and I thought Simone Inzaghi put out some fantastic tactics to confront Pep Guardiola's unlimited money at Manchester
City. The end of the game was just like lights out. It was like real.
It's a great finish, wasn't it? I agree.
Yeah.
Congratulations to City fans. Equity futures right now on the S&P 500 up by 0.1%.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Matteo. In Italy, former Prime Minister Silvio Berlusconi has died. Berlusconi made billions as a media mogul before running for office. He ended up being Italy's longest-serving post-war prime minister. But Berlusconi's more than 9 years in office were marked by sex scandals and allegations of corruption. Still, he was one of the most influential figures in Italian politics the last 3 decades. Silvio Berlusconi was 86. The largest air exercise in NATO's history is getting underway today. About 250 aircraft from more than 20 nations will take part in the drills in German airspace. The goal is to test Air Force's ability to respond to a crisis in Europe at a time of heightened tensions with Russia. And in Philadelphia, an overpass on Interstate 95 that collapsed could take months to repair at a time when summer travel is ramping up. And the roadway fell after a tanker truck carrying gasoline caught fire under the overpass. Now, that section of highway carries about 160,000 vehicles a day. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Matteo, and this is Bloomberg.
Tell me this, we're back in the banking hall. Are you back in your old office?
Yes.
How does that feel?
Good feeling. I think I was very honored but humbled about this new task I have, and the feeling is good, but also there is a clear sense of responsibility to make sure that this thing goes in the right direction.
Completing the biggest merger in banking since 2008, the UBS CEO, Sergio Ermotti, speaking with Manus Cranny back in April, back in his office, but overseeing a much, much larger bank as UBS completes the acquisition of Credit Suisse this morning. Really, really strong language coming out of the UBS leadership. And I have to say, Tom, some of it I think maybe going a little bit too far. There was an article over the weekend in the Financial Times about the UBS setting red lines for Credit Suisse staff as that takeover is completed. And there was a line in there from the UBS chair, Colm Kelleher, who said last month, over taking on Credit Suisse staff, we are worried about, wait for this line, worried about cultural contamination. We're going to have an incredibly high bar for who we bring into UBS. What did you make of that?
I was stunned, and it was the read of the weekend. There's no question. Within the zeitgeist of 8, 9, 10 papers that Lisa, John, and I read 24/7, folks, that's the secret sauce. But the answer is it was without question the read of the weekend, trumping everything involving the former president. And what is so important here is the culture of a bank, whether it's SBC, UBS, and Credit Suisse a million years ago, SBC and UBS be taken out. SBC appropriates the UBS name. And now we're down to one Swiss bank. Lisa, you mentioned this on the break, the cultural, domestic issues of Credit Suisse, UBS. But far more importantly, John, this is over dinner. Pick the hotel. We're at Claridge's in London. And what Mr. Kelleher is saying, ex-Morgan Stanley, ex-Arthur Andersen, this guy's a straight arrow as it comes. And he's saying, we're not going to play the Credit Suisse game.
A lack of trust, I would say, is pervasive and pretty clear. According to people with knowledge of the measures, according to this piece from the Financial Times over the weekend, UBS execs have drawn up this list of nearly 24 what they call red lines, which prohibit Credit Suisse staff from a range of activities. From this to prohibited activities that include taking on clients from countries such as Libya, Russia, Sudan and Venezuela and launching new products without approval from UBS managers. Bloomberg's Jan-Patrick Barnett in Frankfurt joins us now. Jan-Patrick, can you tell me, do they trust their colleagues over at UBS Credit Suisse?
Well, I hope they trust them long enough, or that that trust will be built over time when the merger now goes along. I mean, I totally understand the position of UBS. It's not a merger that they really wanted, and they have seen, as we all have, the things that happened and that went wrong in Credit Suisse. First and foremost, a lack of oversight and a too big appetite of risk-taking in areas that are an absolute no-go for many bankers. So what they now need to pull off is to make sure that UBS, or the new bank UBS, combined with Credit Suisse, stays at, let's say, the moral that they want to have, right? The risk appetite that they want to have, and that investors so far like better than at Credit Suisse for sure. But on the other hand, and this comment is very dangerous in this direction, you don't want to totally upset or annoy all the Credit Suisse people, because let's face it, they will need them. They don't need all of them, that's for sure, but they need the staff, and they need the staff to be happy to work and to feel included and to be part of this merger. Because if they don't, then I'm very, very careful on being positive how this merger will work and how they will keep, especially the wealth management activities, all together.
Well, Jan-Patrick, it's hardly a great start, is it? That quote, we're worried about cultural contamination. We all know some fantastic people who work at Credit Suisse. I just wonder how many people are going to make the cut based on that kind of language.
Yeah, absolutely. And that's the thing when, let's say, when a company is falling in disgrace, then, of course, there is this immediate reaction that everybody is blamed, right? Everybody was a villain, everybody was doing wrong. And that's totally unfair, because I guess there are like the majority of the people at Credit Suisse played by the rules. They did their job. They did it well. They performed well, and they will perform well in the future. And I'm not sure what the intention was with that quote. Was it just like to make another very bold statement to say these are the rules, even though it sounds very harsh, or if there was deeper meaning in that? But it's a dangerous quote for sure.
Jan-Patrick, is this about bad behavior by revenue producers over cocktails at the Savoy Hotel in Zurich, or is it more a London-based, maybe even New York-based warning?
Well, I would say it's a warning, right? But again, you have to have this very difficult thing now to manage out at the new UBS, where you say, we want to keep the bank as it was before. We want to integrate Credit Suisse. On the other hand, we want to make it work. We want to get people on board. We want to feel them comfortable and doing their job as they did before. But to make absolutely clear, what happened at Credit Suisse in certain areas with certain people will not happen again. This language is very strong, but I guess it goes into that direction to make sure, here are the rules, this is the framework we want you to operate in, and if you do that, you're more than welcome to do so.
My question was, who was UBS talking to? Were they really talking to Credit Suisse employees, or were they talking to potential clients that are going away and saying, you know what, we don't want to increase our risk. We don't want to sort of double down on which banks we put our money with. How much is that an issue, that they're not getting the funds from Credit Suisse clients?
Yeah, absolutely. And I was wondering about this question as well, because we have a lot of people who were responsible for some of the mishaps that happened over the past 2 years have already left the bank. So the question is, like, who do you address here? Is it the normal frontline working people who I guess in most cases behaved as they were told to? So it's a very, very interesting thing here, what they're trying to do. And of course, the wealth management, again, they will need those people because every single dollar on outflow will be scrutinized in every quarter from here on until, I will say, eternity, basically. And they have to show like that they can manage the overlap, that they can keep the clients happy, that they can keep the money, and that they can even attract new money with a new entity. And that's the core of the whole merger. It's going to be super hard, super difficult. And we will see if investors are patient enough to give the new bank some time at least to show that this merger is actually working.
Today, the merger closed. UBS officially acquired Credit Suisse, ending the 167-year independence of that bank. What does this mean?
Well, it means something that we have seen in the past in banking, that you can have an institution that does well over decades and decades, and then there is a period where you have the wrong management, the wrong decisions, too much risk appetite, maybe a little bit too much greed in some cases as well. And then it goes down fast, and even faster, as we have seen like in the past. And it tells every investor again that investing in banking stocks needs a very thorough due diligence. You need to make sure that your top management and the level below is doing the right thing, that they're not taking on too much risks, and not too much risk in different areas. And when one thing blows up and the other thing blows up, then the whole entity is getting into question. We have seen that liquidity is still an issue for banks, even though this one was solved, like, let's say, in a good way, that we had no like real default. In terms of chaotic default, as we have seen in 2008. But still, investors learned the message or heard the message loud and clear. Banking stocks still have a risk. It's not just higher interest rates and all is good. And that is the biggest meaning for me from that whole Credit Suisse story.
I was going to say, ask someone who was sitting on contingent convertibles how they felt about what happened that weekend, Jan Patrick. They might have a different view on things. Jan Patrick Barnett of Bloomberg.
Definitely.
Thank you, sir. I think we've always learned some harsh lessons around the banking system, Tom, so far this year. What a few months it's been.
No, my head's spinning on it. And it's great to have someone, Jan Patrick, with real banking experience here. And you saw it over the weekend with, I believe it was again in the FT with Barclays with some challenges as well. What it says to me, and it really harkens into ending June 30, when's banks July 25th or so?
14th, we'll JP Morgan, I think, yeah.
So how do you know that? July 14th?
I checked yesterday
evening.
I checked yesterday evening. I think July 14th. I'll double check for you.
Okay, to check on that now. Anyway, sometime in July, Fortress Diamond's going to lead the charge.
14th.
And I'm going to suggest with respect that their challenges of September in planning for next year in February, it starts way early this year. Just guessing.
From a personnel perspective?
Personnel, how do we keep our top 10%? What are the number of people at Credit Suisse that we have to keep in Asia, in America, in London, et cetera? Those are the kind of meetings you have. I mean, this isn't rocket science. You got a piece of paper in front of you. I don't know if the logo says UBS or Credit Suisse. I'll let you decide. But the answer is somebody's got to write down 10 names and say, we can't lose these people.
Yeah.
That's the dialogue. It all starts earlier this year.
Can we get a pickup in the banking stocks after a rough 6 months? You're starting to see a little bit of that at the regional level over the last couple of weeks. Month to date, that's where the outperformance has been. And we've had some upgrades. Goldman Sachs lifting their year-end price target on the S&P 500, looking for this market to broaden out beyond just the mega cap tech story of the year so far. To weigh in on that, Liz Young of SoFi on equities joining us shortly. Your equity market this morning, equity futures positive by about 0.2% on the S&P 500. You know the diary, the plan already, but here it is again for those of you that don't play and you're just tuning in and you haven't played before. We talk about CPI tomorrow, then on to this guy called Chairman Powell on Wednesday.
The
the market is willing to pay a premium for that scarcity of growth.
Barring some sort of crazy financial market event, I think that we should have a fairly stable move here.
Core is remaining really sticky, and it's really unclear that the trend lower extends.
The overall state of the economy is better. It's certainly much, much better than people expected it to be.
It's very possible that the recession slowdown, part of that has already, been brought forward if you want.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
In many ways, the week begins tomorrow. Chairman Powell 2 days away.
Yes.
Economic data tomorrow morning. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market just about positive by 0.2%. Some upgrades out there that we can talk about, including David Costin at Goldman Sachs, now looking for 4,500 on the S&P and looking for some performance to shift away from mega cap tech and start to see, Tom, maybe this equity market broaden out.
Yeah, Lisa mentioned, I thought Lori Calvasino was quite strong in that at RBC about, the mathematics of broadening the mid-cap, small-cap dynamic, and yes, the bank dynamic. We talked about what's interesting to see how bonds, commodities, currencies correlate into a legitimate equity bull market. And, it makes for good financial TV, the tension between Goldman Sachs and Morgan Stanley's tension.
Morgan Stanley not moving. Mike Wilson not going anywhere. Sticking with the bearish view on earnings. And actually, if you get into the note that came from David Costin at Goldman Sachs, this isn't an upgrade on earnings. This is a view that ultimately the multiple is going to be higher than he thought it would be, Lisa. And that's different to just coming out and saying, we're going to upgrade our earnings forecast. That's not what we heard from David Costin.
It's a great point because it's something we're hearing from other bulls as well. John Stoltzfus, among them, he pointed out that even though you saw revenue growth of 4.25% for most of the S&P 500 that have reported so far, profits were 3.3% lower. So again, you are getting margin compression. This isn't necessarily a bull call in growth. This, to me, is the key issue. Can this continue if rates go up materially from here? Could the Fed kill this?
I'll let the strategists strategize and all that. We just got to keep score of the movement. I went back and looked at this. I really was unprepared. Apple, not NVIDIA, but Apple, 29% off the October low, the Ancampora Yardeni low. John, Apple up 391% from the Ben Laidler low of Christmas Eve 2018. Everybody's like, oh my God, the new iPods may not work out. Oh my, what are they?
I remember that call. I was with you in the radio booth when he made it. I remember that call. And it took some confidence.
There were some other people there with Ben, but Ben was more persistent of it. But this is the nature of long-term investing. You're going back 19, 20, 21, 22. You're back 4.5 years through a pandemic. And, granted, I'm picking a stock that's iconic, but pick a lot of other stocks. These are huge moves that most people haven't participated in. Apple is underowned.
Yes, and I think you should also point out, Tom, that we went through a pandemic, but arguably fiscal support subsidized maybe some purchases of Apple iPhones. During that period, maybe just a bit.
And also subsidize just the juice to the economy. And that leads us to the Fed debate here on Wednesday when we have our team coverage of the Fed show.
Equity futures this morning, positive by 0.2% on the S&P 500. Here's the price action, a state of play. Yields up by not even a basis point on a 10-year, 374.53. I think it's fair to say, Lisa, the week's starting in a way that people would like it to begin, which is kind of quiet, a little snoozy, gearing up for a big couple of days ahead of us.
And there are people right now cursing at the screen saying, just because you said that, you're going to jinx it and it's going to become Armageddon by the end of the day. No one's saying that. But let's just talk about what's for the rest of the week, because it is quieter today. Rate decisions. Wednesday, we get the Federal Reserve. On Thursday, we get the ECB. And on Friday, we get the Bank of Japan. The Bank of Japan is the only developed market central bank that has not raised rates in this entire cycle. Curious to see about how long that can continue. Economic data that's important. Tuesday, very much front and center. Tomorrow, the CPI report from the U.S. Wednesday, PPI. Friday, Eurozone CPI. Very curious to see how quickly you see that deceleration. And how big of a change it would require to really shift the market.
On Bloomberg Radio across this country and worldwide, Lisa's charts this morning are outstanding. And Lisa, that core CPI chart sets up the modest vector of disinflation. We really don't have in place, like in goods, a disinflationary trend.
Which is why I'm watching core CPI, stripping out some of the more volatile sectors. And in politics, former President Trump is going to appear in federal court in Miami tomorrow around 3 p.m. He will appear before a judge on a 37-count indictment that dropped over the weekend. Very interested to see the response, the potential fervor around this, the security, and of course the response from others, particularly in the Republican race and beyond.
What a spectacle. Really serious stuff. AMH, about 15 minutes away. We'll catch up with Anne-Marie in about 15 minutes' time down in Washington. Joining us now on Wall Street on this equity market, Liz Young, Head of Investment Strategy at SoFi. Liz, wonderful to see you, and thanks for being with us. I think the question of the moment, can this market rally broaden out? Can it, Liz?
Well, it always can. And, we're obviously in the beginning of a very important week, and each Fed meeting continues to be the most important one since the last one. But what we've seen over the last week or so is that you are getting some strength from some of those sort of regular stocks. We've got now more than 50% of the S&P back above the 200-day moving average, which is a good sign. And you're getting participation from sectors that hadn't participated in this rally since probably last year at some point. So it's important to have those signals. It's important to see smaller cap stocks participating, because that's what you would expect if we were in the early expansion phase or if we were in a newer bull market. The big question now, and we continue to see this throughout this entire cycle, as we get to these decision points, the next level on the S&P that everybody's watching is 4325, which was the intraday high last August. Can we make it to that point and beyond? And that continues to be the big question. I don't know that we're going to see this strength persist through what continues to be a hiking cycle and pressure on valuations.
Liz, SoFi has a different remit. What are you seeing from SoFi clients, the customers, the people that make SoFi go? What are you seeing in terms of their relative gloom or optimism? I get mixed signals.
Well, it's interesting. We tend to skew younger, especially on the investor side. So you end up seeing
under
a lot
60,
of...
under 60, under 65?
Under 60.
Nice, Liz.
Under 40.
Keep it up, Liz. Who booked her? The intern over here booked her. What the hell is that about? Keep it going, Liz.
Stop. So what you generally see from a younger investor is still interest in headline-making names. You want titans of tech and sort of the disruptors. So there is still a lot of interest and appetite for those names. One of the things that has been surprising to me, that even after last year's tough market, we did a lot of surveys of our investors, and you hear things like, we're still planning to invest just as much, if not more, despite the bear market. So it's encouraging that you still even have, on the younger end of the spectrum, people have appetite for long-term investing and understanding, maybe more so than we expected, that bear markets do happen, that this is part of long-term investing. I think in the short term, the headlines do drive a lot of that sentiment. And obviously something that we've seen over the last week with every investor, not just the SoFi investor, is that once the market starts to move in a different direction and you've got some optimism that starts to show up in the tape, suddenly everybody's sentiment changes. And that's a good thing, I think, for the appetite and the buying opportunities that people might see. However, it does sometimes skew the risk that's still lurking out there, especially in a rising rate environment. So multiple expansion is not something that I think many investors have understood from both sides of the coin in the last couple years, because multiple expansion has been supported largely by monetary policy, liquidity, and now we're in this environment where a lot of that is coming out of the system. I don't think multiple expansion is warranted right now, and it's something that I think starts to sort of trick a more unexperienced investor.
Is big tech no longer interest rate sensitive?
I think it's still interest rate sensitive if you're looking at it just in a growth bucket, right? But that's not necessarily how investors have treated big tech. I think they've actually removed those big names from the growth bucket, and they're thinking of them in a different way, partially thinking of them in a defensive manner. And this is the part of the economy that's going to continue to lead and going to be strong for us for the rest of seemingly our lives. But then there's also this other piece of it that people have gotten very enthusiastic about with the AI theme. The thing about a theme is that you usually invest in a theme for a 2 to 5 year period. There's been so much enthusiasm about AI in the last few months. I just don't think people are going to get the gratification of that enthusiasm as quickly as they want to. So if you're thinking about stocks from a growth and value perspective, big tech is probably acting a bit different than what we would expect from a growthy name in this environment. That hasn't necessarily changed, and it's something that I think has served investors well over most of this cycle. There hasn't really been a big reason to believe otherwise yet.
Liz Young of SoFi. Liz, you're also always welcome back. Thank you, Liz, for catching up. Thank you, as always. Bramo, the pain trade gets more painful, doesn't it? Doesn't it just get more painful by the minute, by the week?
Pretty much on every level, because even if you look at all of those negative signs, like oil prices being lower, like bond yields being generally lower on the long end, you get your confirmation from the yield curve, and you're still wrong, and it's still an issue with big tech leading the way.
And Tom, and then all of a sudden the regionals start to perform. You know, the complaint on the Bears was that it was narrow leadership. Then the first couple of weeks of June started to show some broadening out of leadership.
You know what I'm going to say, John, you know what I'm going to say. I'm going to say companies adapt and adjust, whether they're mid-cap, small-cap, large-cap. But what's interesting here is, yes, the pain trade is about people that got whatever wrong, and they have to rationalize changing their way incrementally or almost a jump condition, as we saw from Mr. Constant this morning at Goldman Sachs. What I would note are the strategists that aren't in a pain trade. They got this right. And again, I'm going to go back to Investing 101. Getting it right is you have to be in the game before you get it right. This idea of waiting with cash and then going long is just a complete fiction.
Getting it right for 2 consecutive years, Tom, that's really, really tough. You think about the people who got last year right, then this year wrong, and last year wrong, and then this year right. That's been the story of the last 18 months.
I'm doing this now in real time, folks. This is what we do with the Bloomberg terminal. Good morning, and we hope you need a Bloomberg terminal. NDX, John, and I'm going to go out here. It's a sales pitch. I mean, you know,
QVC.
Mike from Bedford called up and said, Tom, say something constructive about the terminal.
Right.
How about a NASDAQ 100 up 421% in the last decade? NASDAQ 100 up 17%.
Have you got the B unit on iOS yet?
No, I don't.
Okay.
Mike emailed me. He says, you're the only one in the company who doesn't have this. I'm sorry. I'll get it done.
Get it done. Equities positive, up 0.2% from New York. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Matteo. Former Italian Prime Minister Silvio Berlusconi has died. Berlusconi was a billionaire media mogul before becoming Italy's longest-serving post-war prime minister. His more than 9 years in office were marked by sex scandals and allegations of corruption. Still, he was one of the most influential figures in Italian politics of the last 3 decades. Silvio Berlusconi was 86. Part of a counteroffensive to take back Russian-occupied areas is underway. The Ukrainian military says its troops have freed another 2 villages in the eastern Donetsk region. The claims haven't been verified, and the defense ministry in Moscow hasn't commented. China is denying U.S. claims that it has spy operations in Cuba. In Beijing today, the foreign ministry referred to the allegations by the Biden administration as false information. Over the weekend, the administration said the Chinese spy facilities in Cuba date back to when Donald Trump was in office. And speaking of which, former President Trump is holding on to his Republican base as he heads to court to face federal charges regarding classified documents. About 3/4 of likely Republican primary voters in a CBS News YouGov poll said they view the accusations as politically motivated. The former president is due in court in Miami on Tuesday. And NASDAQ has agreed to buy software maker Adenza for $10.5 billion. It's the exchange's biggest acquisition ever. Adenza's owner, private equity firm Thoma Bravo, will get a 14.9% stake in NASDAQ and a seat on the board as part of the deal. Adenza makes software that's used by banks and brokerages. NASDAQ's software business makes up 1/3 of its recurring revenues. Global news powered by more than 2,700 journalists. I'm Lisa Matteo, and this is Bloomberg.
That I never thought such a thing could happen to America. As far as the joke of an indictment, it's a horrible thing. It's a horrible thing for this country. I mean, the only good thing about it is it's driven my poll numbers way up. Can you believe this?
I was shocked by the degree of sensitivity of these documents and how many there were. If even half of it is true, then he's toast.
Compare and contrast that, the former President Donald Trump and his former U.S. Attorney General William Barr on the president's indictment unveiled going into the weekend. We'll pick up on that story in just a moment. Just want to bring you some details of a story developing right now. The New York Times leading this reporting that JP Morgan has reached a settlement with Epstein victims. I'm going to read you the lead paragraph from their publication this morning. The proposed deal would settle a suit on behalf of victims who were sexually abused by Jeffrey Epstein over claims the bank ignored warnings about him. Just on some of the details from a statement from the bank and the lawyers for the victims, here's a quote, according to the New York Times this morning. They had reached, quote, an agreement in principle to settle the lawsuit on behalf of the victims, and the, quote, settlement is in the best interest of all parties, especially the survivors who were the victims of Epstein's terrible abuse. The statement, Tom, did not disclose a settlement of an amount, but the latest headline is that JP Morgan has reached a settlement with Epstein victims. That headline crossing just moments ago.
This is Jed Rakoff who put this on a fast track. This, again, according to reporting, Bloomberg's had that as well. And I'm very hesitant to do compare and contrast here, but there was previous settlements with Deutsche Bank. One of them is a $75 million settlement and then a $150 million fine to New York regulators by Deutsche Bank here to make it 3 years ago as well. So they're working within this with Jed Rakoff within the past experience of Deutsche Bank as well.
If you are just tuning in, just to repeat that headline, JP Morgan reaching a settlement with Jeffrey Epstein's victims. We'll catch up with the banking team here at Bloomberg a little bit later on this hour just to dig a little deeper into that story as it develops. So I just want to touch base with what's happening elsewhere, just to get you all up to speed on some of the price action going into a key week for financial markets. CPI tomorrow morning, onto the Federal Reserve onto Wednesday. Equities up this morning, Tom, by about 0.2%.
Yeah, the 10-year yield, 10-year tips yield 1.55%. We'll see if we get a breakout on that. So far, we do not see that. We'll continue on what gripped this nation through the weekend, of course, is to move to Tuesday. If it's Tuesday, it must be Miami, and that is where we will see a former president of the United States summoned before a federal court. We get a briefing now from Henry Horton, our Bloomberg Washington correspondent. Of course, balance of power will be completely focused on this issue as we move over the next 2 days, the next 48 hours. Amory, I never do this with you, but I'm going to do it. It's not about Red Sox taking out the Yankees. An open question here on what matters for you. What is the point you're studying this morning as we move to tomorrow?
Well, we now have the indictment, right? Those charges, we got them Friday going into the weekend. So we do know, as former President Trump's own attorney general called them damning. He said even a half as true, then he thinks the former president is toast. What I'm really looking at is the fact that following the release of that indictment, two of the former president's lawyers left his team, and the former president said he would be announcing more lawyers to add to his team. He's going to be represented by Todd Blanche on Tuesday. I'm interested to see who would be running to want to defend the former president in this case and what kind of legal team he is able to come up with, whether by Tuesday or the next few months. Of course, the other big thing I'm watching, which you guys mentioned a number of times, is how this plays out politically for the Republican Party, because that CBS News poll really shows the hold the former president has on the base of the Republican primary, which means he has a very clear path to win the primary nomination. Just this one, if convicted over classified documents, Trump should be able to be president. 80%, 20% said not be able to be president. So this just shows what the former president said, which is when he gets indicted or he has a big legal struggle ahead of him, his poll numbers go up. The issue, of course, is that that's not true for those outside of the Republican Party, and potentially would mean a failed bid for him if he was to be the candidate in 2024 in a general election.
Well, AMH, the distinction you're drawing is an important one, the difference between campaigning in a primary and campaigning in a general. Can we just focus on a primary just a little bit longer? Can you talk to me about how other candidates have responded to this over the weekend?
Well, you've had really a mixed bag, right? You had Governor Chris Christie come out, and this is really also part of his shtick on why he's running. Some are calling him a kamikaze nominee. He's coming out and he's obviously saying he doesn't agree with many of the things the former president does. But on this line, he also wants to take a path of, I want to wait and see all of the proceedings of this. Everyone continues to say, we're in America, you are presumed innocent unless proven guilty. That is a line the likes of Governor Chris Christie is taking. Others, Jonathan, are also having a hard time on walking this line because it's easy for them as well, like we've seen from some of them, Governor DeSantis, to go after the Justice Department and talk about how this is political because they do not want to ostracize the Trump base and those voters, because those voters, as you can clearly see in poll after poll, continue to support the former president. So it's going to be very difficult for them to really talk about this until there's a judgment that is going to be coming from this jury.
Does it make it difficult, Anne-Marie, for the Republican Party to be the party of law and order if there is this question about the institutions that are executing that order?
I mean, I think it's difficult for some of them to talk about law and order in the sense when it comes to the former president, whether it's law and order of the Justice Department or law and order, because many are also concerned of potential riots or violence or just maybe protests that get out of hand when it comes to the former president on the ground in Miami. I think what you see a lot of Republicans wanting to do is paint this as Joe Biden's Department of Justice and trying to politicize it. But what we heard from the current president is he said he's never spoken to Attorney General Merrick Garland on this, and he has no comment at all regarding this case.
MH, can you talk to me about timeline, just to wrap it up? How long this is going to take?
Your guess is as good as mine. I think what you'll see from the Trump team is that they are going to try to use every tool in their toolbox to slow the process down. They're not going to want this to be quick and speedy. Remember, this is all happening under the fog of a primary race. There is one tool that they likely would have used but was taken away from them, which is the fact that this is already on Trump's turf in Florida. If this was going to be in Washington, they likely would have tried to move it to the Southern District in Florida and have this done, this court be held in Miami. That's already been done. Trump has a huge benefit there, given the fact that this is a jury of a state that he won. The judge at the moment is a Trump-appointed judge. But, Jonathan, this could be drawn out for months and go well into 2024.
AMH, down at DC. Anne-Marie, we'll catch up with you a little bit later. Anne-Marie, thank you. Just to refer back to that CBS News YouGov poll, the president, 61% likely GOP primary voters. Who would you vote for today? 61% Trump, DeSantis 23, Scott 4, Pence 4, Nikki Haley 3.
Yeah, I think it needs a lot more polling here. I really would lean on Gallup to tell us how large that primary size is versus the rest of the public. John, no surprise here. I'm going to let you give us wonderful perspective on this. Silvio was an unequivocal protagonist of the last 50 years for Italy, charisma, a visionary for sports, and loved by a community. Mario Draghi, moments ago. Thank you, Maria Tadeo, for that. Here's what John grew up with, which is Berlusconi and AC Milan.
Pretty emotional for the football club, Tom. Took it over in 1986. Built it into just a powerhouse of Europe, which went on to have phenomenal success through the late 80s and early 90s with the Dutch trio. I'll put two stories together for you, Tom. This is it for me. The problem with the former president in this country is he thinks far more than 74 million people voted for him. The problem with a lot of the media coverage is that 74 million people actually voted for him. And it reminds me of Berlusconi this morning because of the way a lot of people will cover this story. Tom, he was well loved by a lot of people, including that football club, AC Milan. If you are just tuning in, Silvio Berlusconi has died. Equities advanced just a little bit on the S&P 500 by 0.26%. A lift on the Nasdaq as well. Adding some weight to that rally, up by 0.5%. And the outperformance month to date coming from a surprising place. The Russell, the small caps, month to date for the month of June, higher. Much, much higher. The regional banks up by about 12% this month. Just a phenomenal run for some of the regionals after really getting beaten down over the last few months for obvious reasons. The Russell this morning up by 0.3%. Into the bond market, 2-year, 10-year, 30-year. The 2-year at the moment, 461 going into the Federal Reserve on Wednesday. Will they won't they? Might come down to CPI tomorrow morning. For others, it might not at all, TK. Perhaps even if that is strong, that's just a reason to take a pause, a skip, call it what you will, and wait for more information going into July. 375
in the 10-year. On July 26th, will we be at 4.00 or 3.50? That's the arch debate, I would suggest right now.
And the Fed speak, Lisa, isn't going to drive that. What will drive that possibly is going to be the economic data between now and then.
Which economic data? I keep wondering, right? I mean, if we're doing this, it has been the preeminent issue because the data has told very different stories. In these single names that the stories that we're watching, Tesla, those shares have gained $3 billion as a result of some of the charging deals that it did with Ford and General Motors. It's now an electric charging network company as much as it is a car manufacturing. Those shares continuing their gain, 1.7% ahead of the open. PacWest also continuing their gain, considering that has seen a big lift, driving up some of the regional bank shares up 1.4%. Exxon, this to me is the big question. Can you get a full broadening out in equity market rallies if you don't have the participation of energy? Those shares lower by nearly 0.9% after a pretty damaging year. And then finally, JP Morgan shares popping about 0.4% immediately on the news that they did settle that Jeffrey Epstein lawsuit. Seems like there is a sigh of relief that perhaps there at least isn't that overhang, John, on the bank's valuation.
Agreement in principle, just such a sad story. Such a sad story. One that JP Morgan, I'm sure, wants to leave behind, Tom.
Yeah, they are. And in the New York Times reporting, they mentioned Deutsche Bank previously. We mentioned that in the last hour. And there's a process to this agony, and that's simply what we're all going through.
We'll refer back to that story through this morning for you. We're going to try and catch up with the Bloomberg banking team a little bit later on in the programme. For markets, 2 days away from the Fed decision, Robert Tipper, PGIM, fixed income, weighing in on the potential impact on bonds, writing the following. In all likelihood, the message will simply be one of expect us to keep the funds rate here for a long time. If and as markets begin to bite down on the message, no cuts on the horizon, but maybe some hikes, this could precipitate a stair-step higher in yields across the curve, Tom. So not just a call on the front end there, a call right across the curve.
Focus on the equity market, but we must focus on what equity pros focus on, which is the fixed income space. Is it PGIM? They have been very good for total return over the recent decade. Robert Tipp is chief investment strategist for PGIM. Robert, just simply right now, what are you doing to adjust for a mid-year adjustment? Everyone in equity land is adjusting like crazy, particularly bears or near bears. How does fixed income adjust?
Right. Well, I think to Lisa's point there, are people ignoring some of the data and some of the market messages? In terms of the equity market, people have been very zeroed in on the narrowness of the rally with tech stocks, but the fact of the matter is, on a country basis, Europe, Japan have been doing really well from even before the U.S. So there's a breadth of growth out there. And the reason I mention that is because that is the threat to the fixed income market, is that the economy is doing reasonably well. But if you wondered what a price wage spiral looks like, I think you're looking at it. It's been some time here where wages have budged. They've moved up. They're not surging, but some of the settlements that you see around the world coming out of negotiations are high. And inflation, on a core basis is running around, the better part of 5%. And there's not a lot of signs of deceleration there. So maybe it's not a wage price spiral, but it's certainly a wage price race. It's a horse race out there, and that is what could cause it to be a very long time for inflation to come down, bring us back to that comment of the Fed being at these levels for a very long time and not putting a little bit of upward pressure on the middle of the yield curve.
So there's a lot to unpack there. And let's just start and sort of elaborate on your point about a wage price spiral basically being here, or a wage price escalation, whatever you want to call it, a skip, jump, pause, whatever. I am curious about what data you're looking at to give you that assertion, considering the fact that Fed officials have said that their concerns about a wage price spiral have been eased. We've heard a number of others saying the same kind of thing, especially with the deceleration recently.
Yeah, you could make that comment from average hourly earnings. And if you really wanted to be optimistic, you could even make it from the ECI, Employment Cost Index. But those sample sizes, especially on payrolls, I mean, they're not particularly large. They're subject to revision. And the ECI running at about 1.1% or so. On a trailing, I think it's around 5% actually. I mean, there's not been a lot of deceleration there. And, when you look at what's going on in the labor market, there's been a huge growth in the labor force, and the hiring is going on at a multiple of the pace needed to stay at full employment. So, if you want to drill down and you want to be optimistic, you can find things that say, oh, yeah, no, this is going to be okay. But that's usually the way it ends up going, the way you don't want it to go for longer than you expect. And that's what I think market pricing is missing here.
The irony is that JP Morgan put out a paper saying that if bonds are right, stocks have to sell off by 20%. And bonds usually are right. But this time, Robert, are you basically saying that stocks are right, that bonds need to catch up to where stocks are, and that will necessitate some sort of response from the Fed?
Yeah, I mean, I think I'm saying the markets actually, to me, markets look right. When you look at these large cap companies in the stock market, earnings growth is not fantastic, but these companies have seen a lot of action over the last few years, just like everybody else, and they've come through pretty well. So they're showing a resilience to calamity, granted with a lot of fiscal stimulus, but they've shown a lot of restraint on the way back. So they have a lot of cyclical resilience on the way down. And they've shown a fair amount of ability, not in real terms really, but to hold up and keep their earnings in an inflationary environment.
But what does that mean?
So I think that's, maybe what's supporting this market. But overall, it looks like a good investment environment out there for long-term fixed income. But there are some things to avoid, like pricing on parts of the yield curve in particular.
So how much could that mid-year yield curve go up? In other words, are you looking at a pretty substantial rise in yield price lower?
I think you're looking at a slow burn. Tom asked the question, we're going to be here, are we going to be at 3%? Your market pricing, a year or so out has over 100 basis points of rate cuts priced in. So the market is banking on that turnaround. And so I think you could see a very slow increase in the range for 10s. You could see them push up towards 4%. And if it turns out you need these 5% plus Fed funds rates for a very long time, or in the case of Europe, pushing 4% for a long time, right, et cetera, around much of the world, you're going to see, you could very easily see over the next 1, 2, 5 years, 50, 100 basis point right, slow burn move higher in rates.
Robert,
out the curve.
I find interesting here, Robert Tip, the idea of an ambiguity between rates higher, rates lower. Obviously, somebody has their own belief in that. Is the solution for mere mortals to barbell or to ladder out maturities, as Kathy Jones of Schwab mentioned to us last week?
Right. Well, I'm a mere mortal portfolio manager. And yes, barbelling is an approach, and being tactical on the curve. And the reason I mention mortals as portfolio manager is, if you're an individual and you're buying your bonds on a buy and hold basis, that may not be that effective. I mean, there are opportunities in terms of floating rates, structured product, very high quality, that's going to key off of the funds rate, where the yields are pushing 7%. And there are opportunities in the longer term credit markets, again, where the yields are much higher than cash. Number one. Number two, the pricing's been extremely dynamic. So before SVB, the Silicon Valley Bank debacle, there was pricing in the very front end of the curve, the first right, handful of months, that was extremely attractive, and you wanted to have duration there. And then post SVB, that you may want to be short. So tactically, what we've seen over the years is cycles for the market right, have been compressed into weeks and days. And so that may not lend itself well to kind of a static barbelling approach.
Robert, very quickly here, we're out of time, but this is too important. Gazillions are going into money market funds. All my radar's up. What's the mistake right now of piling into 5% plus money market funds?
Right. My expectation would be, there are two possible problems there. The one is the economy is much weaker than expected. Rates drop, and they end up losing their income, and they haven't locked it in for what their real time frame is, which is saving for the long term. The other thing is there's a lot of alpha in the market further out the yield curve and in the credit sectors, and they're obviously not going to be availing themselves of that.
Robert, tip of Jim, on a cash trap at the end of that conversation. Keep going back to this, TK, the cash trap. Now. The risk of getting stuck in cash at the moment.
I look at it like AI. Everybody's in AI because we're in AI, because Dan Ives told us to be in AI. We're in AI. Everybody's in money market funds. All my radar's up as to why are they in money market funds and what's the other side of the discussion. And Tip nailed it there, as he always does.
It's the barbell of 2023. On the one side, you've got cash at 5, and on the other side, the hopes and dreams of AI and NVIDIA. And some other names
and
too.
there was some really good stuff. John, you nailed this LVMH move, and there's some really good stuff over the weekend on the behavior of luxury and can it endure, just simply based off the idea China will reopen so luxury will do well. I mean, same idea.
That tees up our next segment beautifully, because at the moment...
there I try to.
Perfectly.
They're in my ear. Talk luxury.
There's been a big shift away from the hopes and dreams of China's reopening and the rest of the world outperforming, and just creeping into conversations. US exceptionalism. There's been a conversation about that over at Standard Chartered. Steve Englander coming up very shortly from Standard Chartered. Why him and Eric Robertson think that maybe we are too enthusiastic on US dominance and not enthusiastic enough, Tom, about China and everything else.
4360 SPX. Is it rounded up Monday? 4,400 on SPX? Is that where we are?
A bit premature, but Tom,
a bit.
Who knows? Got to get through CPI. Get through the Federal Reserve. We'll see where we are on Friday. From New York City, equities up by 0.3%. Welcome to a brand new trading week. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. JP Morgan Chase has agreed to settle a lawsuit alleging it knowingly benefited from former client Jeffrey Epstein's sex trafficking. The bank says it reached an agreement in principle to settle the proposed class action filed by an unnamed Epstein victim last year. Epstein is a disgraced financier who killed himself in a Manhattan jail cell. In Italy, former Prime Minister Silvio Berlusconi has died. Berlusconi made billions as a media mogul before running for office. He ended up being Italy's longest-serving post-war prime minister. But Berlusconi's more than 9 years in office were marked by sex scandals and allegations of corruption. Still, he was one of the most influential figures in Italian politics the last 3 decades. Silvio Berlusconi was 86. The largest air exercise in NATO's history is getting underway today. About 250 aircraft from more than 20 nations will take part in the drills in German airspace. The goal is to test Air Force's ability to respond to a crisis in Europe at a time of heightened tensions with Russia. In Philadelphia, an overpass on Interstate 95 that collapsed could take months to repair at a time when summer travel is ramping up. The roadway fell after a tanker truck carrying gasoline caught fire under the overpass. That section of the highway carries about 160,000 vehicles a day. And Novartis has agreed to buy Seattle-based Chinook Therapeutics for as much as $3.5 billion. The Swiss company will acquire 2 promising treatments for a rare kidney disease. Novartis will pay $40 a share for Chinook, a 67% premium to Friday's close. Another $4 a share could be paid later if the medicines achieve certain milestones. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Oil, copper, and the rest of these markets don't have a positive carry. So they cost you to own it, cost you to store it. You're going to drain down these inventories as much as you can. So oil, copper, they are a liability right now. They are not an asset. And until they become an asset, no one's going to want to hold them.
Jeff Curry at Goldman Sachs speaking to the team here at Surveillance on Friday, going into the weekend. We have never been this wrong for this long without seeing evidence to change our views, and then they changed their views. Here's a new forecast.
It was because of Lisa. She grilled him.
$86 Brent forecast for year-end. That's down from $95. This according to a note to clients this past Sunday. There we go. Crude right now, Tom. WTI, 68.
67 on WTI when I walked in the door. I got to admit, I was shocked. John, it's so important what Jeff Curry said. We've got to review it quickly. when you have a new rate regime that's like it was 15 and 20 and 30 years ago, that doesn't just change the banking business. It changes every sector, every business. And all of a sudden, when Lisa has 2 barrels of oil in her living room, if she's believing we're going back to 120, down 43% from when she sold her oil, she's got to carry costs
Bought when they were
now.
negative, remember that, Tom?
Yeah, she's got to carry costs now. It costs her money to have 2 barrels of oil in her living room.
It always
unlike
did,
the
let's
last
just be
time.
honest.
Unlike the last time, so we'll see there as well.
China a big part of this story. The latest note from Eric Robertson at Standard Chartered, really worth a read if you can get hold of it. Markets are losing faith in the FOMC's ability to bring down inflation and in China's ability to engineer a sustainable economic recovery. We believe markets are too bullish on the US. Tom, they believe that markets are too bearish on China. They look to sell the US dollar.
And as we're repeating, whether it's Eric at Standard Charter or Stephen at Standard Charter or Surveillance Heritage, as we protect the copyright of all of our guests, get this important research from a Standard Charter bank. Mr. Englander is Global Head of G10 FX Research at Standard Charter as well. There's a consensus trade right now. If we see dollar dynamics, Stephen, let's go back to first principles. Is it going to be a relative rate move or is it a flow move of capital?
Right now, I think it's mostly a relative rate move that, and I think what the market is focused on is not so much the level of U.S. rates, but the degree of confidence that there's sort of a ceiling to it, that they'll probably announce one hike. The market's pricing in one more hike. We think not, but that's they're not pricing in 2 hikes. And as long as it's the case that it's one hike that's priced in and then they're done, we think all the carry trades will be put in place because I think the market will be comfortable that they won't get blown up by on the dollar side by dollar rates.
Give a scope and scale on euro. You're saying the euro wakes up in 2024. What does a move like from, say, 107, 108? How large can that move be?
Well, we're thinking now 114, so it's not a colossal move, but it's still kind of significant, and it would bring it back into the range that it was before the Russian invasion. Again, it's a story that the ECB isn't quite done. We think the Fed is likely to be done, although it's a close call. As with China, everybody is super pessimistic on Europe. There's not, in a call that we had, it was on China, but, my colleagues were saying that they don't know of anyone who's optimistic. And when the market is that one way, it's not the question of is the economics right or wrong. The question is, have the expectations overshot?
Just to sort of double down on what you're talking about, Stephen, if on Wednesday the Fed does skip, pause, whatever, and we do see some sort of signal, they may tighten more, but they may not. Will that be dollar negative in a substantial way? Will that be the catalyst for this move?
I mean, if that's all they say, and if they leave it sort of implying that they might do one move, I think the market would rally and risk trades would get put on. I think partly it's call it the sociology of markets. Wednesday could be a landmine if they sound more hawkish than expected. So a lot of investors who want to put on short dollar trades, long risk trades will hesitate. And they don't need the Fed to be super dovish. They just need the Fed to kind of be as expected. And then they'll put on the trade. So I think if they have one hike in the SEP and they sort of imply that they're going to do one more hike, markets will be satisfied with that and sort of continue to sell dollars and buy risk.
Is positioning more or less fragile than it normally is? Because what I hear is a two-sided market, which is good, and people actually not piling all into the same trades and not having a tremendous amount of conviction. Or do you feel like it is perhaps a bit more lopsided?
Well, I'd say they have a tremendous amount of conviction, but they're afraid to express the conviction with positions because they've been blown up so often. So I think that the market is really waiting for a piece of news that says the Fed is done, whether it's payrolls that comes in at 50 or 75, so it's the U.S. economy is clearly slowing down, or some indication from the Fed that they think that they're getting traction on inflation, so they don't have to go that much further. Once they get that, I think that, that's the moment when a lot of these trades that people have been thinking about for months will actually get put on. But I think till they have some degree of certainty that the upside risk to yields has been really, really curtailed. They're reluctant to, put on the trades that they want to put on.
Steve Englander, there is a devaluation. I'm going to use the difference here, folks, between depreciation and devaluation is the power of the bank. I'm going to suggest, Steve, as an amateur, that Beijing has some real control over dollar yuan, dollar renminbi. And the basic idea is we've had a devaluation from 6.70 to 7.14 on Chinese yuan, a much weaker yuan. At what level in your mind do things start to unravel for the government in Beijing? Is it a 7.15 or is it out 7.20, 7.25?
Well, I've heard clients actually say as high as 7.30. I mean, it's hard to pick these levels. Chinese inflation is very low. And so the usual risks from a weak currency sort of aren't manifesting themselves in the way that you would expect them to. The thing is, the Chinese exports aren't doing that badly either. So it's not a kind of competitive depreciation to ramp up exports. What Chinese policy needs to do is get domestic demand going. So I think they're letting the market take dollar CNH up, but without particularly endorsing it.
Hey, Steve, wonderful note. Once again, thanks for the read over the weekend. Steve Englander there of Standard Chartered together with Eric Robertson. They went through the scores post-May, the Fed meeting on May 3rd. So you go from May 4th. I'll do that for you now. The S&P 500 up around about 6% since the Fed last met. The real moves come at the front end of the yield curve, and it hasn't damaged the appetite of the equity market at all. We've had a move of more than 80 basis points on a two-year yield since this Federal Reserve last met. So, Tom, the equity market in the United States doing okay in the face of a reevaluation of where the Fed's going to go, which is to take out rate cuts and price in possibly more hikes. The dollar strength starts to kick back in, and the mood changes. All of a sudden, it's about the potential for US outperformance through the year ahead, and what Steve and the team over at Standard Chartered are pushing back against is exactly that. They're saying we're too bearish on China, too bullish on the US.
Yeah, they're taking a contrarian view, but I think the theme I get from your and Lisa's great study of these strategist changes over the last 48 hours is growthiness is back in, multiple expansions back in, and if you like growthiness, you got to go find growthiness, and that's all the stocks that are going up. I'm going to look at the gloom side and say 210s is screaming recession, negative 86 basis points, and if we break down under 90, I'm looking at the moving average I use on that, and we're almost there. And that's really showing recession, economic slowdown, where growthiness is even more valued.
How long can you scream recession for? 2-year, 10-year, Lisa has been at those levels for a long, long time now. Been screaming recession for the last 12 months?
Don't they say that the yield curve, the inverted yield curve, has predicted 45 of the last 8 recessions, and that seems to be the feeling out there. There is this issue, though, as you say, with yields higher, that stocks have been able to rally. Does this matter, right? How much is this basically that just incremental shifts aren't going to jog people out of what they are in terms of the growthiness and the optimism of U.S. equities? Or is there a threshold at which suddenly tech stocks become interest rate sensitive again in a way that perhaps people are discounting?
The language shift is interesting too, yes. Tom, to describe Steve Englander as contrarian when that position was so consensus for most of this year. Then you get 2 months going the other way, and all of a sudden that's the contrarian view. That's the contrarian view now.
Yeah, and that's what I noticed there is there's no big figure moves. I mean, basically, 107, 114 is fine, but he's not looking for a lot of drama out there. I mentioned earlier Apple off the Laidler low. The GM equivalent, instead of up 17% a year, is up 2% per year. GM off the low of Christmas Eve of 2000.
Are you going to be able to charge your GM a Tesla charger, Tom, in a few years' time?
I can charge my AirPods at my Tesla.
Charge my phone. That's just dreadful at the moment. The life of the battery, awful. Awful.
My new phone is great.
That's exactly what they want, Bramo. You know that.
It's hard to believe that we can have all this tightening and not have an economic effect.
That sort of great year it had in 2021, I think you're going to pay for it for several years.
It's the strength of the consumer that, would probably drive a recession.
Now the Fed is in a much more difficult scenario, I think, because they have to guide to keeping rates higher.
It's very deeply ingrained into markets that the Fed doesn't like to surprise.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most interesting Fed week. We welcome all of you on radio and television. Much to talk about with the market lifting, the death of Silvio Berlusconi in Italy of note, and John Hannah Levitt and Ava Benny Morrison reporting for Bloomberg. Bloomberg reports a settlement of this agreement, this horrific episode with Mr. Epstein with our largest bank, the J.P. Morgan Company.
It hasn't been a quiet start to the week,
no.
Has it? There was some thoughts out there over the weekend that maybe the week started tomorrow. On to tomorrow, US CPI, the next data point. On to Wednesday, the Federal Reserve decides, and a choice for the Federal Reserve: a pause, a skip, or a hike. Alan Zentner over at Morgan Stanley saying pause, Tom, they're done. First cut comes next year. Then you've got skip. Bank of America, Mike Gaper, who believes they take a skip at this meeting but ultimately consider going again at some point in the future. And then you've got Andrew Hollenhorst, who was stuck right the way through it.
Yes, he was.
25 basis points. They're going to hike. That's his call. Let's see if that changes tomorrow morning.
In mine, is it going to change tomorrow morning? Because all that matters is data dependency, and the data dependency is 8:30 tomorrow. Core inflation.
Is that data saying hike again? If they change their projections and they have to upgrade inflation,
Lisa,
downgrade unemployment, Lisa, is that going to say we should be hiking?
Honestly, Mohamed El-Erian came out and said if they were truly data dependent, there's no reason for them not to hike. If they want to signal
0.5.
Well, not necessarily. They can go incrementally, but nonetheless, if they are truly data dependent, the data has been telling them a lot of strength. If they want to say we want to take a look at what the hikes to date actually will do to the economy, then they should say that. He argues there should be more clarity, and then just say we're going to keep them there for a while and just measure the information coming out. Right now, the guidance is unclear because they don't know what they want.
I think the phrase keep it there for a while is key. Everybody's focusing on level, and it makes for good TV and radio. But can he dare say in the press conference on Wednesday a duration of whatever the decision is? I think that's fascinating.
I don't think he wants to corner the committee into something like that. That would be Draghi-esque. I don't see that happening anytime soon. What we have seen over the last few weeks is a senior member of the committee, Governor Jefferson, presumed future vice chair, basically come out and say we can skip. And I think that's why a lot of people believe that's the consensus view. Now, Tom, going into Wednesday, and let's see what the projections say. Let's see what those projections say. They might even imply a higher median dot.
You mentioned Hollenhorst, and at least I thought it was interesting what he said to you and me. I believe it was on Friday here. I mean, he is just flat out stated they must move higher. There's no other nice way to put it.
If you're data dependent, they have not achieved their goal. They're not that close to achieving their goal. You're seeing that momentum. And Robert Tipp just now from PGIM Fixed Income talking about a wage price spiral. That was supposed to be well off the table with unemployment seriously moving higher. It is not. And so how do they respond to that?
Part of wage price spiral is the buoyant consumer in America, a resilient consumer. John, you see that in the equity market today. To talk 4360 on SPX. Wow.
Lisa asked the question last week, and this rally broadened out month to date over the month of June. That's exactly what it has done. The small caps doing better, the Russell, the regional banks doing better as well. So that's been a story for us. Equity futures on the S&P just about positive by 0.3%. I'll leave it with this, Tom. It was something that Kathy Jones or Charles Schwab said to us around this table last week, and it's something I've considered as well. You can pause but get tighter. And you can pause but get tighter because real rates stay elevated, Tom, because inflation's coming down. So you can maintain the nominal rate at a certain level, but if inflation is falling, by definition, monetary policy is getting tighter, isn't it, if you're not adjusting with it?
Well, that's the key thing here. We're back up to restrictive state here. Now, there can be any measure of plus or minus points, but the effect clearly is if we are restrictive, if we are neutral in some way or form, where do we go next? With us as a student of this, Drew Mattis with Maury Harris years ago at UBS was definitive with an optimistic take on the American economy during the depths of 08, 09, and 10. He holds court at MetLife Investment Management, head of global economics and market strategy. Drew, can you give me some of that old Maury Harris optimism this morning? Can you be optimistic away from the gloom of recession?
Unfortunately, Tom, I can't. So this time around, we're going to be on a little bit on the pessimistic side. I think if you look at a number of indicators, claims, ISM, bank lending, they're all pointing towards a negative outcome for the U.S. economy. You then add on things like the Senior Loan Officer Survey, you add the increase in the unemployment rate, you look at gross domestic income, which has been negative for 2 quarters in a row. The data doesn't support a huge amount of strength in the economy. The data supports that things are weakening. And I think the Fed's going to pause because I think they need to see how fast things are weakening. Remember, if they're going to land this thing, they want to try it for a soft landing. They don't want to crash it.
Do you ascribe then to the idea that when rates break and move lower, they'll move with rapidity, that we'll get where Ed Hyman and others talk about, really right down to a 3% level or even break 10-year yield on 3%?
I don't think we're going to go that far. I think the one benefit, if you want to call it that, of kind of the inflationary story that we've seen is that it might have broken this kind of low rate environment that we've been in. And we'll have to see how that plays out. We do think yields are going to move lower from here, but we don't think they're going to return to kind of the 1% level, 2% level. We're expecting year end will be around 3.5%.
Could yields go lower, and could you get a recession and still have equities move materially higher?
You can. I think, equities are going to be very much forward-looking, whereas the bond market's trying to figure out kind of what the new neutral level is. And they're having a little bit of difficulty now with that because of the inflation story. And because productivity is so ridiculously weak, it's a real hard guess at where potential growth in the economy is. And then you layer in the fact that firms are still hiring people, even though the people they're hiring are probably unproductive, right? That's why the productivity numbers keep getting worse. And we're still seeing that hiring. And the question is kind of how long can firms keep doing that? Just because in the past it was difficult to keep people employed or to find people to fill spots.
Well, the reason why I ask is because there has been this surprise to the upside with respect to certain economic data. But companies have seen profit compressions. They have seen some sort of damage from more discretion from consumers in particular around certain purchases. At what point have companies, to Tom's point, adapted and adjusted? And we have right now, especially the biggest companies, a sort of removal from some of the negative economic data and, frankly, even a recession that might be mild.
Well, so you always see disparities as you enter a downturn, and I think the key point for me, quite frankly, is that there's a lot of faith being put on the consumer, which means it's all being put on the labor market, and with the exception, quite frankly, of the headline payroll number and the breadth of that number, the other indicators within that report are somewhat negative. One of your economists at Bloomberg actually did a great piece looking at the SOM rule, but looking at it by state, and seeing how many states are in recession. And when you look at how many states are in recession and what percentage of GDP they represent, it's about a quarter of the U.S. economy would be in a recession, according to the SOM rule, as of last month. And that was before the 0.3 increase, which probably added more states to those already in recession.
Yeah, Drew, you nailed this. And it's the only reason Claudia Sahm talks to me. And the basic idea within that importance is that we, all of us, macroeconomists like yourself, professionals, and people in the financial media game, we aggregate. Is MetLife looking at America as two Americas, or can you still sum it together?
I think you have to still sum it together, but I do think that there's a lot of discrepancies, whether it's in terms of savings and who has the excess savings and what they're potentially being used for, whether it's spreads in the unemployment rate. The Atlanta Fed wage tracker, if you look at job quitters versus job stayers, fine, quitters are still getting paid more, but that spread is narrowing, which tells you the bid away for those employees is going away, which would indicate softening in the labor market. You've had unskilled workers outperforming skilled workers from a wage gain perspective. You've had more highly educated workers underperform less educated workers from a wage perspective. So I think a huge amount of the strength we've seen and potentially a huge amount of the job openings we're witnessing are for lower skilled work. And it's not clear to me that those job openings ever get taken down because the turnover for them is so high. And so I think we could be in a situation where the data is looking pretty good, only because people are having such difficulty filling, certain jobs, but that, other jobs are actually still going wanting or disappearing, and it's just not being captured in the data.
Hey, Drew, wonderful to hear from you. Drew Mattis there of MetLife. This labour market in America is so confusing right now.
Yes.
We had the establishment survey showing payrolls a couple of Fridays ago looking pretty decent. You had the household survey showing unemployment climbing. And we'll get another read this week on what's happening here. We'll get retail sales a little bit later this week. Let's see what economic activity looks like. We'll get jobless claims as well. Arguably the back half of this week, Lisa, could be just as interesting. Thursday morning, claims and retail sales in America.
I'm glad that you said that. We also get the Empire Manufacturing Survey, so the first read that we get on what's been happening in the month of June. This, to me, this confusion highlights that we are not out of a pandemic, or that the pandemic has transformed or highlighted some of the transformations underway in the workforce. And it's not just simply the basic work from home or not. It's which jobs. It's the dearth of the physical economy needing to be refilled. It's the fact that a lot of the frontline workers were decimated during the pandemic and have not been rehired after all of the layoffs during that period of time. And that's fueling job gains despite the weakness in other areas, not to mention even the bifurcation between manufacturing and services.
Some of those workers haven't even come back, Tom. You've seen the scramble from the airlines trying to get pilots, trying to get flight attendants. Capacity is never going to recover there either, because some of those airlines don't want it to, based on what ticket prices are doing.
I had a beverage of my choice this weekend, and with it, I had to buy a little thing of olives. It was $9 for the olives.
Where do you go? I mean, this is not normal.
Try macadamia nuts.
Yeah,
seriously.
Exactly. And I'm like,
unreal.
I said to the manager, the food was great. I was like, they killed it. And she said, every marginal cost we have goes to labor. Every penny goes to keeping...
Just to be clear, that was a restaurant or a store?
It was McDonald's, 3rd Avenue.
They do olives now.
Yeah, they
and macadamia nuts.
Which one? The one on 58?
It was the Soho Grand McDonald's. Soho Grand, they nailed it this weekend.
I know when TK has got some money off the bill. That's the difference between TK and me. So Tom goes out, and then on the Monday mentions the restaurant because he wants a discount next time he goes back. I go out, then on the Monday I never mention the restaurant because I want no one else there. I don't want people to know it's good. I want it to be quiet. I want my table. Yeah, not empty. I want some ambience, but just, I want to be able to get in.
We dragged Afterthought there. She ordered a charcuterie. I'm like, I didn't know what a charcuterie was till you explained it to me 3 years ago.
8:30 Eastern Time, about 20 minutes from now. Ian Shepherdson at Pantheon coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. JP Morgan Chase has agreed to settle a lawsuit alleging it knowingly benefited from former client Jeffrey Epstein's sex trafficking. The bank says it reached an agreement in principle to settle the proposed class action filed by an unnamed Epstein victim last year. Epstein is a disgraced financier who killed himself in a Manhattan jail cell. Part of a counteroffensive to take back Russian-occupied areas is underway. The Ukrainian military says its troops have freed another 2 villages in the eastern Donetsk region. The claims haven't been verified, and the defense ministry in Moscow hasn't commented. China is denying U.S. claims that it has spy operations in Cuba. In Beijing today, the foreign ministry referred to the allegations by the Biden administration as false information. Over the weekend, the administration said the Chinese spy facilities in Cuba date back to when Donald Trump was in office. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The press conference is going to be absolutely the most interesting element. How they describe the skip, which the market expects, is going to be critical. Now, if they don't get favorable inflation numbers, they're in a really hard situation because they will have to surprise the market.
Always great to catch up with Mohammed Al-Arian on Fridays going into the weekend just to get us set for this week as it gets started. Citi don't think they skip. Citi thinks they hike. Andrew Hollenhorst publishing just moments ago. Our base case, the Fed will simply raise rates 25 basis points this week. This is out of consensus, he acknowledges, but more logical than signalling more hikes will be necessary, but then delaying the next hike until July. Just for anyone who's interested, they don't just think they go 25 at this meeting, Tom. Collectively, he sees another 50 basis points of tightening coming from the FOMC and Chairman Powell over the next few months.
On the data dependency, you can make a case for going that way. And then, as I mentioned earlier with Robert Tipp, you can go the other way just as easy. I don't have a stake in this. I really don't have any strong opinion because, John, it's still original pandemic monetary theory, fiscal theory, and such. It's a cliche, but it is new territory.
You can identify where the consensus is. It's backed up for good reason. Most people assume skip because we've been led to believe by core FOMC officials, Governor Jefferson being the prime individual over the last few weeks, that that's the direction it will go in. My question, Tom, and it's an open one, is how much of a big upside surprise would we need on CPI tomorrow morning to change that consensus view?
Lisa, what do you think?
Going into Wednesday?
0.6?
We were talking about this earlier in the morning, and basically it sounds like it would have to be quite a bit. There are two theories here. If they want to assess the damage of existing rate hikes, they need to wait. It's unclear why they should stop waiting, and what they're looking for is number one. And if they're following the data truly, then it shouldn't take that much because the data has come in hotter than expected. Which is it?
TK?
Well, I don't know. I just have to wait for the data, and it's what America's doing with inflation.
They're data dependent. We'll wait for the data.
Yeah. No,
I'm with you.
I'm frankly focused on the July meeting. I think is way more interesting. You get to Jackson Hole. What's he going to? Is he going to cut the speech at Jackson Hole from 8 minutes down to 6 minutes?
To be honest with you, TK, I can't wait for Jackson Hole. Just the compare and contrast of the speech a year ago to the one we'll see in August. Are they sufficiently restrictive? And how on earth do you go about coming to any conclusion on that? Are we seeing longer variable lags that are much, much longer than we thought they were? Because we've all termed out debt with very low interest rates and all that good stuff. If you have, again, congratulations. It's my weekly congratulatory comment around that. If you did get 2-3% rates and lock them in for 30 years for your mortgage, great stuff. Or are we finding out this U.S. economy can just stand up to rates in a much, much stronger way than we thought it could do?
The ambiguity right now, futures up 10. The VIX 14.62 off that 13 level. I'm still not used to saying that, to say the least. This is an important conversation. For the next 48 hours, the last 48 hours, there has been an uproar about our democracy, about our present president, and about a past president. We need to clear the air, and we will clear the air on July 23rd when she issues a public good. Whether you're Republican or Democrat, Elaine Kmart, senior fellow at Brookings, is going to redo her magisterial primary politics, everything you need to know about how America nominates its presidential candidates. It's 276 pages. Elaine, do you have to rewrite the book 30 days before you put it out?
No, listen, there's no way I could write the book about 2024. The book does, however, include 2020. And 2024, however, will, I promise you, follow some of the basic rules of presidential primaries that I described for many years.
Because of time, I'm just going to cut you off here and say it's as simple as this. You are the one who studies the rules. Are there rules now as we go to this primary season, given what we'll see in Miami tomorrow?
There are certainly rules of the game, and Donald Trump's operatives are fighting hard to get rules that are sympathetic to him. In Michigan, just this past weekend, they had a state convention, and the Trump people and the not Trump people were wrangling over what kind of rules would help Trump. Trump people know that he is a plurality candidate. He was a plurality candidate in 2016. He will be a plurality candidate now. So he needs rules. He needs winner-take-all rules. He needs rules where he can get 38% of the vote, have the rest of it split up, and win all the delegates. And that's what he's trying to do. He did that successfully in 2016 in a large field. So he needs plurality rules. And then he needs to hope that all these candidates stay in the race for the whole time and split up the opposition to him. What he fears most is that someone will emerge in the early primaries who is a credible alternative to him, not an anti-Trump person, but somebody who can shave off just enough of those hardcore Trump people, you don't have to get all of them, to add them to the never Trump people and get a somewhat normal Republican as the nominee. And he's very vulnerable to that. What's happening in Miami, what's going to happen in Georgia, what's going to happen with the feds on the January 6th investigations, all of those are going to make him an extraordinarily vulnerable first runner. I don't think, I have to go back all the way to Jimmy Carter in the Democratic primaries of 1980 to find a front runner who was this vulnerable.
Just quickly here, I'm curious if he can continue to run in the same way with federal charges pressed against him. This is unprecedented. There really hasn't been some sort of example. What is the legal barrier here?
There's no legal barrier. And the reason there's no legal barrier is that we always forget the nomination process is a party process. It is not a state process. So if the Republican Party in Michigan or the Republican Party in California says, we're going to run our nomination process this way, we're going to elect delegates this way to our convention, that is under the First Amendment, freedom of association. So this is up to the Republican Party. This is not up to anybody else. So he can be under indictment, et cetera, and the Republican Party can decide, well, we're running a nomination contest, and he's in it.
Elaine Kmark of Brookings. Elaine, thank you. No doubt we'll be catching up with you again soon. Big day tomorrow, Tom, in Florida.
Oh, it's a huge day. I mean, and the thing I guess I've understood through the weekend is it will not be like the big day in New York of a number of weeks ago. This is going to be a radically different process than, remember sitting there at 3 p.m. looking at a hallway and, down at City Center.
Yeah, I don't even think personally, Tom, I paid much attention to it. Not in the same way at all. This one tomorrow, Lisa, is so much bigger. And this goes back to something we were talking about just earlier this morning. So much of this country, the general public, has become desensitized, particularly the Republicans, and that's been conveyed, shows up captured by that poll from CBS and YouGov over the weekend.
It goes to the core of this disbelief in the larger state and the state institutions, and sort of this question around whether they're more allegiant to politics than they are to their goal. The more that happens, the more there is an existential question around the United States that you keep hearing from international allies. And I keep going back to this because regardless of what happens with this case, we heard about this, about some of the G7 negotiations. People were talking about this. Well, if this person's going to be president, we're going to have to navigate this particular issue. So these are some of the things that I'm watching, regardless of the outcome of this particular case.
I'm going to go back to Stan Druckenmiller at the Bloomberg Invest Conference with Sonali Basak last week. He said the uncertainty, I don't have the exact quote in front of me, but he said the uncertainty is immeasurable right now. I think that's true politically. It's true in the investment world as well.
That's one thing we can all agree on, Tom. Coming up in the next hour on Bloomberg TV, Anders Persson of Nuveen, Mira Pandit of JP Morgan Investment Management, George Bory of Allspring. Great lineup to start the week. Going into the Federal Reserve decision on Wednesday, going into inflation data tomorrow morning, retail sales jobless claims rounding out the week onto Thursday. Lots to pay attention to, including the ECB rate decision just around the corner as well. Equity futures on the S&P just about positive, looking to add some more weight to the recent rally.
Bloomberg Surveillance, Lisa Abramowicz and Tom Keene, John Ferro getting ready for the next hour. Futures up 8, Dow futures up 19. I'm going to call it a fractional list. NASDAQ leading the way. Ian Shepherdson's with us with Pantheon and macroeconomics. We're going to get to him in a moment, but we thought we'd get 3 questions with Sreen Natarajan, not only covering Goldman Sachs, but all of New York City at Wall Street, and joins us now over a principle of agreement or something like that, where JP Morgan will move money to people of terrible abuse in Mr. Epstein. Sri, the story's not over for JP Morgan. What is the next chapter for James Dimon and his bank?
It certainly isn't. And let's take a step back as to why JP Morgan is in the headlines right now. It's been 4 years since Jeffrey Epstein died, but the bank over the last several months has been facing a pair of lawsuits alleging that it benefited from Epstein's sex trafficking. One was brought by an Epstein victim in a proposed class action, and the other is from the U.S. Virgin Islands, which pretty much had the same accusation against J.P. Morgan. The news we're getting this morning is J.P. Morgan has reached a settlement with the Epstein victim, so at least that should put an end to that case is the hope. But their legal troubles are not over. They're still facing the U.S. Virgin Islands, and they have also sued their former top executive, the person who then went on to become the CEO of Barclays, Jess Staley. So there is still some legal wrangling ahead for J.P. Morgan.
How much does it matter, the amount that the fine was? I mean, we were getting a sense that perhaps there was a 75 million figure from Deutsche Bank. What range is the range that starts to matter for J.P. Morgan?
You know, honestly, we will be in guesswork territory if we had to figure out what they paid for settlement. But it is fair to assume that it won't be a big hit in terms of a financial, in terms of its financial, in terms of a big number. That's not what the big item is from this settlement. The bigger issue is it's not just J.P. Morgan. It's across Wall Street what you have seen through these lawsuits, through some other documents that have come out, that a lot of Wall Street was willing to stomach close associations with Jeffrey Epstein for his wealth, for his influence, for his Rolodex, completely ignoring his criminal conviction.
Which perhaps is why they backed away from Chris Pinotti so quickly on allegations over there, and I wonder if that was part of it. I do wonder, just are there other banks that you're watching that could get roped up into some of these settlements and these lawsuits in the upcoming months?
Primarily, we've only seen it tied to J.P. Morgan and Deutsche Bank. We have seen revelations of executives at other banks having had associations with Jeffrey Epstein, but it's not just other banks. You have college professors, other financiers across Wall Street. It is more about the industry's willingness to associate with individuals like that.
A movable story this morning. Sri Natarajan, thank you so much. And again, Bloomberg reports this is Hannah Levitt and Ava Benny-Morris and J.P. Morgan reaching an agreement to settle with an Epstein victim. Right now, we turn to traditional surveillance coverage. Ian Shepherdson joins us, chief economist at Pantheon Macroeconomics. And one of the great things about the Shepherdson purview is we have to watch China. He and Duncan Wrigley have been out front on this for years. You said years ago, Ian, we have to pay attention to China. You people look at it every day. What's the consensus get wrong right now about China?
Well, there's a couple of things, a couple of stories that I think are really important. The first is that the rebound, the China rebound that everyone was so excited about 6 months ago has been a lot less impressive than we all hoped. And that is generating the second point, which is disinflation, deflation pressure coming from China. China's PPI inflation is negative. It's probably going to go more negative. Excess productive capacity and just not enough demand is pushing down China's PPI. And that's going to push into global manufactured goods prices. China is kind of the price setter for global manufactured goods, and that means downward pressure pretty much everywhere over the whole of the next year.
They're going to export disinflation. I mentioned this, folks. Ambrose Evans Pritchard with a clinic on this in the Telegraph the other day. How much is the percentage amount you would calculate that the impulse of Chinese disinflation will bring down U.S. inflation?
Well, we're only talking about goods, of course, and remember that the U.S. core CPI is mostly a service price index. But at the margin, downward pressure on goods prices, which I think could be heading to a zero inflation rate over the course of the next year in the U.S., and currently about 4 or 5%. So really quite substantial. Now, that's not all due to China. It's also due to some recompression of U.S. domestic margins. But the China impulse, I think, is going to be very visible and very helpful to the cause of lower U.S. inflation, and Europe too, over the course of the next year, and starting pretty much right now.
Speaking to this inflation debate with China, there has also been a shift away from China being the factory of the world and an increase in lobbying power and, frankly, labor's power in general in the U.S., in Europe, as a lot of the manufacturing gets nearshored or onshored. So how much do you see something of a wage spiral continuing regardless of what happens with China, regardless of what happens with headline GDP growth?
Yeah, I think wage pressure is diminishing, but it's still elevated. I mean, we're not seeing the sort of numbers that we're seeing in 2021 when U.S. wage growth was 6%. It's more like 4 now, depends exactly which measure you choose. But it certainly had some momentum that I think has lasted longer than a lot of people, me included, expected. But I do also think that we're now on the verge of a meaningful weakening in the labour market, including in manufacturing. And yeah, I know that the reshoring is very much a thing. You can see that very clearly in the US construction data in manufacturing. But in the labor market, it's starting to struggle somewhat. You know, the ISM manufacturing survey, the benchmark national survey, is very weak, and it's been weak for some time now. And that labor market softening, I think, is going to take some of the edge off the wage growth over the next half a year.
What are you looking at to highlight this softening that so many people thought would already have happened, but hasn't yet?
Well, it's everywhere except the payroll numbers, isn't it? I mean, if we look at the small business survey from the NFIB, that's at recession levels. The official index of leading indicators, deep recession levels. ISM manufacturing, recession levels. Payrolls, $250 a month, private payrolls. I mean, so there's a real disconnect. So that can solve itself in two ways. Either all the surveys can rebound magically, or payrolls can weaken, which I think is much more likely. You know, the Fed's raised rates by 500 basis points in 15 months. Normally, that would be more than enough to push the economy into recession. I don't think this time will be any different. We just got to wait a bit longer.
This time will be different. There was a Newcastle that was mid-level Premier League, and they had arguably the best year of anyone, maybe except Man City. And your Newcastle Union, I mean, they're just surprise, surprise, surprise. What's the Newcastle out there that will keep this economy going?
Well, you know, the consumer is always a bit that has the potential, because there's still a lot of savings left that were built up during the pandemic.
The Biden stimulus is still benefiting
Some
a
of it
large
is.
body of America.
Yeah, but there's about 2/3 of that excess savings has been spent now, and what's left seems to be mostly in the hands of higher income households who probably are less likely to spend it. But it's an unknown, because we can't look back at any previous experience and say, you know, the last time this happened, the outcome was X, because there is no last time.
But the unknown, the known is that everybody got the recession call wrong except a very select few. Can you time a recession right now? Or is this so original you just give up?
Yeah, it's very difficult. You know, plus, of course, you've got to remember that the GDP numbers get revised forever. So in real time, it's very hard to tell, which is why the Fed put so much emphasis on the labor market. You know, they're very keen on the SARM rule. Unemployment rises by 0.5 point. You've got a recession, whether GDP says so or not. We're not there yet, but my guess is that by the end of the summer, we'll either be there or we'll be very close.
Do you think that if the Fed does pause and doesn't raise again, we could get inflation down close to 2.5% by the end of this year?
Oh, absolutely. Absolutely. You know, the headline rate's going to drop very sharply anyway in the next couple of months, just because of base effects from last year. But the core also, I think, is likely to soften. I think we're going to see real margin compression across retailing, where we had huge expansions during the pandemic. And I do think that the labor market is going to weaken as well. So I'm very hopeful that the Fed has done enough. And I think if they keep hiking, they'll have done more than enough. And the recession will end up being deeper and longer than it needs to be.
If we do get a headline CPI print tomorrow that is above expectations, how do they justify and say that they are still data dependent? Or is that a misnomer? Are they not really? They're just sort of feeling their way and using that as an excuse.
Oh, they're definitely feeling their way. I mean, that, you know, they've been very clear that that there's no grand plan here. It's a case of see what happens in the numbers. So, but I think that tomorrow's pause has been fairly well flagged. This is a Fed that doesn't like to surprise. So I'd be quite surprised. Unless the CPI numbers are just absolutely wild, they're not hiking this week.
But isn't it kind of silly? Isn't it silly that they're not just basically saying, we need to really assess what we've done, so we're going to just take a breather, and at a certain point, we'll signal when we're done. Not this hawkish pause, skip, whatever kind of confusion that leaves them with less credibility from a lot of people in the markets who say, don't be too cute. We don't know either. We just want to see what's going on.
Yeah, no one knows, for sure, because we're in a completely unprecedented environment here. So having done 500 basis points, faster than any hiking cycle since Paul Volcker in the early 80s, why not take the summer off? Skip June, skip July, go to the beach, come back up to Labor Day.
Let's stop there. I mean, you beautifully frame that back to Volcker. Some would say they massively screwed up. Others would say they just got us back. Dudley would say they just got us back to where we ought to be. But what's the downside if they pause?
I don't see much, because
exactly
there's no sort of residual inflation pressure waiting to leap back if they stop raising rates for 3 months. But by sitting back for 3 months, we get a lot more data through the summer. We'll have a much clearer idea in early fall of the lagged impact of their cumulative actions, which is what they keep writing about in the statement, but don't seem to be taking very seriously with this reliance on the short-term data. So this is a strong case.
Lisa, I had the clearest memory of being at AEA in January of, I'll say, 09 or 10, and I'm going to give credit to Olivier Blanchard. Worthies were up on stage, and Blanchard had a chart up saying there's no pain to just waiting for more information. And that's where I am on this pause, whatever. I think he's dead on.
I agree in theory. The problem is that a lot of these Fed officials and a lot of economists are conditioned by getting it so wrong back in 2020 and 2021 and not moving quickly enough and not trying to counter some of that stimulus. How much is that the driving factor that's going to perhaps push people in the opposite direction this time around?
Yeah, it's skewed their decision, shall we say. I think that's probably the right way to think about it. The decisions which in previous Feds might have been much closer, they've gone on the hawkish side. And transitory was a complete fiasco, a debacle. It was politically damaging to the Fed. The media hated it, the markets hated it, politicians hated it. The Fed was just the whipping boy for everybody. So, having made that mistake once, you can't make the same mistake in the same direction again in the same cycle. So you're going to on the other side. But again, I come back to this point. They've raised rates 500 basis points in 15 months. It's been super aggressive. And actually, Jay Powell said at the last press conference, we're tight. Real rates now are tight. And you just got to wait for that to work its way through. Everything would be so much simpler if the payroll numbers were behaving, but they're the outliers, but they're the ones that the markets and the Fed put the most emphasis on.
We're going to say goodbye to Ian Shepherdson of Pantheon Macroeconomics. I'm going to put the surveillance cork in my mouth because I may get in trouble here. 3.72% 10-year yield.
About what?
25 beeps up or down, Lisa, 6 months out. Nobody has a clue.
Nobody has a clue. Nobody has a clue.
We have a guess.
We've got guesses, and we can flip it on the day.
Futures up nicely, up 11. Stay with us. Mike Mayo next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. JP Morgan Chase has reached a tentative settlement with sexual abuse victims of disgraced and deceased financier Jeffrey Epstein. The lawsuit claims the bank knowingly benefited from Epstein's sex trafficking. The deal would settle that proposed class-in lawsuit filed late last year in Manhattan federal court. A settlement amount has not been disclosed. In Italy, former Prime Minister Silvio Berlusconi has died. Berlusconi made billions as a media mogul before running for office. He ended up being Italy's longest-serving post-war prime minister. But Berlusconi's more than 9 years in office were marked by sex scandals and allegations of corruption. Still, he is one of the most influential figures in Italian politics the last 3 decades. Silvio Berlusconi was 86. In Philadelphia, an overpass on Interstate 95 that collapsed could take months to repair at a time when summer travel is ramping up. The roadway fell after a tanker truck carrying gasoline caught fire under the overpass, and that section of the highway carries about 160,000 vehicles a day. Novartis has agreed to buy Seattle-based Shinkook Therapeutics for as much as $3.5 billion. The Swiss company will acquire 2 promising treatments for a rare kidney disease. Novartis will pay $40 a share for Shinkook, a 67% premium to Friday's close. Another $4 a share could be paid later if the medicines achieve certain milestones. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Wednesday could be a landmine if they sound more hawkish than expected. So a lot of investors who want to put on short dollar trades, long risk trades will hesitate. And they don't need the Fed to be super dovish. They just need the Fed to kind of be as expected. And then they'll put on the trade. So I think if they had one hike in December and they sort of imply that they're going to do one more hike, markets will be satisfied with that.
Stephen Englander, Standard Charter there with all of his work over the decades on foreign exchange as well. Part of what we're looking at here with a nice lift to the market. Futures up 12. NASDAQ up 0.5%, just refuses to go down. We'll see how that plays out over the day into that important inflation report. It is part to have a memory here at Bloomberg Surveillance of time long ago, and the memory can, well, it can be a certain evening when someone's let go or this, that, and the other. But I had the clearest memory of an evening in 2000 in the uproar across global Wall Street when Mike Mayo was shown the door at Credit Suisse. We are thrilled to have Michael Mayo with us, managing director at Wells Fargo, here, off of 20 years, I will say, Mike Mayo, of covering banks, of covering UBS, of covering Credit Suisse and the rest. So let's talk about this historic day. We go SBC, UBS takes out Credit Suisse, and here we are. Was this because of greed? Was this because of the absolute demand to create revenue? We don't care what the quality of the revenue is going to be. We just need to get new revenue. Is that what happened to your Credit Suisse?
Well, I didn't officially cover Credit Suisse, but I can comment on the European banks, which has woefully lagged the U.S. banks. And some of this is structural. After the global financial crisis, they did not recapitalize at the pace of the U.S. banks. And some of this is simply cultural, which I lived through. And it was sometimes growth at any price, growth at, extraordinary risk. And so I'd say there are some culturally flawed European organizations, several that I worked at, but it's played out through the numbers, and it's relevant to my analysis of the U.S. banks now because Goliath is winning, and the Goliaths are the largest U.S. banks.
Is Mr. Armati in his red lines going to be a change agent? And can Mr. Diamond, with a completely separate issue, this Epstein scandal, be a change agent towards a more discerning choice of clients?
Well, know your customer is banking 101, and I don't deal directly with, say, the investment banking clients, but I have a compliance exam several times a year, as does everybody on Wall Street in the United States. But there might be more restrictions on which clients you're allowed to take. So there's going to be an extra check. And so it's not all clients come to us. It's going to be a smaller subset of what you deal with today.
You said Goliaths are winning. Are the smaller banks losing? Just putting aside Europe.
Yes. We conducted an analysis. We did a kitchen sink analysis where we had 4 haircuts. One haircut was deposits leave by another 8%. In the industry. Another haircut would be provisions equal to a recession level, extra expenses for new regulation, and we have the Fed funds rate go all the way down to 2.75%, which would hurt the net interest margins. Regional banks get hurt by 25% to earnings. Large banks get hurt by maybe 5%, 10%. So Goliath is winning, and Goliath is winning even more. But I wanted to make one clear statement today, and that relates to actually the regional banks are making some comeback. And so the statement is that the detour...
cheesy. Carry on.
Okay, well, I'm cheesy. I have my props. But the detour for not owning bank stocks is over. So
for those of you, it's like in construction. For those of you on the radio, he's got, give me that road sign over there. Bring in a stop sign next time. Mike, stop. End detour is what he's saying on radio. It's one of those orange. It's one of those orange signs.
No.
It's like the real sign. What did you do? Steal this off the construction sign for the Bloomberg?
How's your head, Tom?
No, he stole this sign off the construction side of the Bloomberg pothole at Lexington and 58.
All right. The prop aside, I am wondering why now? Because you talk about this potential 25% hit to their profits. This is significant. Are you basically just saying it's priced in? We've priced in all of that and then some. So it's time to hoover up some of these smaller stocks that have gotten beaten up.
Well, when I say the larger regional banks, look, they're not going to zero. You had your failures from idiosyncratic events. They're not raising equity, at least the largest banks. Look, you've had 3 banks that were in the S&P 500 at the start of the year that failed. Okay, that's done. All right, so this idea, this almost hysteria as relates to the largest banks is over. And it's been over for the last 4 weeks. I mean, the banks have gone up by over 10% during that time. They've outperformed the S&P 500, but they've no way caught up to the broader S&P 500. So you're saying what could have legs in the market? Bank stocks, the larger bank stocks certainly could, like a U.S. Bancorp, which has been pummeled. And it's one of the highest quality banks out there.
Although, in fairness, they haven't gotten pummeled as much as some of the others. And I do wonder, I get your point with those particular ones. Do the largest mid-sized banks hold up, even if you get additional failures on the lower end at a time when the emergency lending facility at the Fed is still being used at a pretty significant rate?
Well, I'm going to avoid your question just for one moment. There was big news last week, and I think the one outlet that really picked up on it was Bloomberg. There was over $10 billion of debt issued by the large regional banks. It was the first issuance since the failure of Silicon Valley. It was 4 to 5 times oversubscribed, and the spreads came in pretty well. So for those banks, yes. Below that level, below the level of the top 10 banks, it's still to be determined how much wherewithal they'll have to access the debt markets. That hasn't happened yet. So you're right, there is a divide. Goliaths are winning. The next level down is tap the markets. Below that, it waits to be seen. And once you get past this acute stage, you still have a recession with commercial real estate. And most of the commercial real estate loans are for banks below the top 10.
Move the decimal point, Mike Mayo. Citigroup, after a 10-to-1 reverse split way back, $4.83, which is basically unchanged from 2009. I detect some Jane Fraser moves. They seem to be consolidating and simplifying the process. What does the next Citigroup look like?
The next Citigroup looks a lot like the old Citigroup before the merger in 1998. So this is Citigroup's silver anniversary.
This is gospel, folks. This goes back to when Mayo was canned at Credit Suisse. Continue.
And so this is Citigroup's silver anniversary. It's their 25-year anniversary, and it's certainly not a cause for celebration. The stock's down over 3/4 at a time when the stock market's more than tripled. They failed on almost every measure.
What is she doing different? What is the courage she's doing right now to get them back to John Reed?
Well, she's simplifying. You know, the old adage, Tom, is that global banking, wholesale banking is global, consumer banking is local. And that even predates this merger. This goes back to Walter Wriston. And we're talking about a 50-year failed strategy where Citigroup thought they could go ahead and, have a customer in Hong Kong whose kids go to boarding school in London and they vacation in Aspen, and we're going to serve that
like
super...
Lisa's life.
What's that?
No. It's like Lisa's life. Lisa, get one more question in here.
So anyway, that's failed. She's reversing that, going global with wholesale and getting rid of the non-U.S. consumer.
You dodged one thing, so I'm going to come back to it just real quickly. If smaller banks start to fail again, are all bets off with the largest regionals?
The smallest banks are not systemic. There's over 4,500 banks. You're going to have bank failures. That's a rule of banking. But it's not going to be any bank in the S&P 500, in my view, over the any immediate time frame. So that phase is over. It's this idea of Tom, you can hold it up. The idea
Please don't hit your head again.
The detour away from banks has ended.
Right.
If we can...
okay, we got 20 seconds. End detour. End detour. What's your single best buy right now?
I'm going with J.P. Morgan and Citigroup as my top 2 picks, but I'm also adding in there right now U.S. Bancorp, which has been relatively pummeled given the quality.
Should have hit him on the head.
No.
Mike Mayo, thank you so much.
Jump across
This
the
is a
table
really
and
big
grab
deal,
it.
folks. For global Wall Street, livid when Mayo was canned by Credit Suisse 23 years ago. To have Mike Mayo with us on this important day for Swiss banking is a huge deal. Michael Mayo is with the small U.S. bank, Wells Fargo. We thank him for being with us today. I'll tell you, Lisa, could I have said this 5 years ago or 10 years ago or 23 years ago when we were screaming on the phone about Mayo being let go at Credit Suisse? You can't make this stuff up.
He nailed it. And frankly, it was probably a blessing. I love those stories.
Are there stitches?
Really,
need to go
let's not hit our heads going forward.
On radio, my deepest sympathies. Libby Cantrell at the 10 o'clock hour. Good morning.